morning. Great. Good to see a room full of wealth managers, and I love the early morning conversations that I saw outside. It seems all are excited to be here, isn't it? Yes, no? Great. So, welcome all of you to the second annual Family Office Summit and Awards, presented by Radisson, our co-presented partner Spark Asia Impact, our exhibit partner NextGem SKP, Rurash and Capwise, and conceptualized and curated by Transformance Forums. I'm Sharon Verma, the Associate Director, Head of Conference Production from Transformance, your host for the day. It's a pleasure having each one of you, and a very unique subject that we have on Family Office. A lot of exciting tracks, starting from the keynote to panel discussions and interactive breakout sessions, right? So before we start off, just a quick moment to throw light on the purposes with which you walked into this room this morning. May I have 2 or 3 of you to volunteer and share your purpose of joining us for the conference today? May I have any of you to volunteer? Yes, sir, please. Can we have the mic?
Yeah, good morning, everybody. I am from House of Patel Family Office. My purpose of coming here is to interact with the people because earlier, last 2 years, there was no physical thing interaction with there. To gain the experience from the other family offices and to learn from the speaker also. That is my expectation from this takeover.
Welcome, sir. Round of applause for him, please.
Hi, good morning. I'm Srirang Atle from Aurum Ventures. We have recently set up a family office because we have a successful real estate project which is generating around about 2,000 crore surplus. So now we are looking at family office to invest this surplus. So I thought it will be good to get acquainted with people who are involved in family offices and learn from you. Thank you.
Thank you, sir. Warm welcome to you. Big round of applause for him.
Good morning all. I am Ritika. I am from Tipsons Group. So I have recently started my careers into debt market and I am here to interact with all the family offices. So I am based in Mumbai and I am here along with my senior, Mr. Deepak Bansal. So we are here to interact with all the family offices and look forward to connecting with all of you. Thank you.
Thank you and welcome. So great. Welcome each one of you once again. So we start off with the session. I'm very, very privileged to welcome our chairperson for the day, Mr. Swaroop Mohanty, CEO, Mirai Asset Investment Managers Private Limited. A very warm welcome to you, sir. A big round of applause for him, please.
And on behalf of Mirai Asset, I'd like to thank Transformance for giving us this opportunity to be part of this incredible gathering. I mean, when I see the people in front of me, and I was just sharing that we slogged to meet one of you individually. But to see all of you together is just incredible because I started my career in the early 90s and when I started doing mutual funds towards the late 90s, I was with Kotak and early 2000 we started discussing this concept called family office. And I had no clue of what family office would mean. And then one of my seniors would tell me that with the unfolding of the economy, wealth would be created at individual levels. It will go to a level where it will be needed to be managed separately. And I was thinking that it was absolutely alien that such a thing could happen to India. Please understand, and there's some article coming out today about me being Gen X and how I perceive investments. I consider our generation to be the most confused generation when it comes to investing because we saw the economic insecurities of our previous generation and that baggage is always with us. That so much money can happen in India was something which we could not fathom. But towards, I think, 2002 or 2003, that's when I had this great fortune of seeing the birth of the Azim Premji Foundation or the Azim Premji Family Trust because my younger brother, my first cousin, was the first wealth manager in this country appointed by a billionaire to manage the money. And I went to the Wipro campus and I was shown his old house and this is where the office would be housed. And then too I was wondering, do you need this kind of a setup to manage? And that's when he said that people with that kind of public standing need to be invested responsibly also. And that's when it dawned to me that things are going to be very different. And today when I look at the crowd in front of me, I'm just pleasantly amazed at what I'm seeing. It's very fortunate to see both of us sitting in very similar roles, because our roles are both fiduciary in nature. And then when you are given this power to safeguard somebody else's money, it is a huge responsibility. And I feel it's only lucky people who get to sit in those chairs, and I consider myself extremely lucky to be doing this kind of a role in my life. People can do a lot of other things, but to safeguard somebody's money in a prudent way is God sent. But that comes with its own challenges, because when we look at our business from the perspective of managing money, a lot is changing. And when you look at the underlying, I think the first significant change that happens is the regulatory environment, which practically is changing by the day. And today for us, and forgive me for saying this, the challenge as an asset manager is not to put a performing fund house in front of you. The challenge is to put a clean fund house in front of you. And that's where the risk, the compliance, and the regulations take over. I mean, as we grapple in this changing world of underlying transparency, sometimes lack of transparency, or in the process of showcasing transparency, how do we build that up? I mean, recently, from inside, we thought, from a regulatory perspective, there was this need for putting up a separate trustee officer. If you look at AMCs, the regulator forced that upon us, that you now need to have a separate trustee officer which will report to the trustees and in a way report to SEBI. But we thought, why not take it one step ahead? And now, I think today or maximum by Monday, we're giving out our offer for the vigilance officer on our side. And that vigilance officer who will sit in our office will not report to the CEO, but will report to the board. And that will be a kind of a, what can I say, apart from the audits, a separate kind of internal check where the AMC does not have any role to oversee our business, and it can be another checker point for us as we pursue this business of being vigilant and being extremely regulated in the way we work. So as we look at these changing environment from the regulatory perspective, it is also important that we sort of uphold this responsibility. And slowly but surely, I'm pretty sure there will be recognition on this part. I don't think the recognition of this is still very relevant at this moment, but sooner or later, whether a particular entity is extremely compliant will figure fairly high on the due diligence of any fund house is something which will happen quicker than we think, apart from the returns that we check. And that's where we are headed. The other part is, as you look at the equity side of the business, or whether assessing any organization perspective, I know I'm saying this at a very, what can I say, a little bit of a doubtful time. The emergence of ESG is serious. The emergence of ESG is a fact globally. And when you look at ESG emergence globally, it's not a coincidence that it's most relevant or prevalent in Europe. The recognition of ESG is on two parts. One is the regulatory part. The other is when the investor wants it. And my humble request to this August gathering would be to look at the merits of ESG and look at demanding ESG as we speak. I was with in an important session with the EPFO of the country, and my only request to them was to demand for ESG. It's when a large investor like them starts demanding for ESG, our portfolios also change. So it's difficult for us to perceive that doing good and making money don't go together. But when we look at ESG, it is something which happens. And when we look at the 150, 170 parameters which ESG sort of looks at beyond financials and corporate governance, is just ensuring that the organization aims at doing good, and in doing good will the organization make money. It'll take some time for countries like us to scale it up, but let me tell you, there is absolutely no doubt or debate on enforcing it from a regulatory framework. And it will, again, I dare say, will happen quicker than we think. Now, the other part which we grapple today is the change in the IPO market. I mean, as mutual fund investors, we look at new issues with a lot of exuberance because that's how the market gets expanded. But you look at last 1-2 years, the changing behavior of the IPO market is something which has stunned us. The mad rush for valuation and the ability as fund managers to differentiate between a valuation person and a serious business owner now is beginning to unfold in the last 1.5 years. And how we look at that space is something which time will tell whether that IPO market will be revisited, both from a promoter perspective of how the promoter, he or she, looks at building the business, because once you come to the public market, it's a very transparent market. And in earlier days, it is the journey starting with the public market. But now when you look at some of the last issues that have come, it's like there's nothing left for the mutual funds when the issue hits the market. And being on the coveted anchor list is not turning out to be as good as it used to be earlier. There used to be a fight for anchor list, but things are not the same as they were in the past. The other part which grapples all of you and grapples us is this huge debate around alpha and alpha generation. And it is a fact that as economies become transparent and markets become mature, alpha generation takes a hit. But here's the thing that I'd like to leave behind is that when you look at the basic segment of the market which is discussed very openly is the large cap side of the market, and the general advice is don't take the large cap, take the Nifty 50. But when you analyze the Nifty 50, we are talking about 37% being financials, and you just add IT, it goes up to 45-46%. So my thought now moves from a return generation to risk management. Any large cap fund in the market will be far more diversified than Nifty 50 at this moment. Do we recognize that fact is something which I leave back on you. Yes, alpha generation is an issue, and I can say with a fair amount of conviction, you can Google it also, that this is now discussed at a regulatory level also. Many of you have to realize that fact that from an investor perspective, and that's where the regulator comes from, it will not allow us to go 37% in our portfolios to any sector. We can go up to 20-25%. We cannot go beyond 10% per stock. And that the regulator will never allow. But there are stocks which have now breached 10%. So while there can be discussions on alpha generation, practically it is impossible to beat the benchmark at this moment because of these major factors. And is it right for a diversified fund to be above 10% in a particular stock? I leave that to you. Now for once, as active managers, I'm very proud to stand in front of you on behalf of the industry that we didn't need a certain report to tell you that we don't want to buy this stock. The broad industry had stayed away from a particular stock, and that's the job of an active manager too, to identify certain things. And please understand, the industry was actually underperforming that entire period and was okay with it. Just shows that the risk mitigation part was intact. And for once, I'm very happy and proud to be talking about that in front of you. And with the discussion on alpha generation, of course, comes the discussion on passives. And the emergence of passives in the last 2-3 years is a story in itself already. And once you breach the big threshold of basket making going above 25 crores post-April, the market at the underlying level from the infrastructure of passives or ETFs completely changes. The liquidity factor of us will be tested. And here, just selfishly speaking, Sanjay, is that I'd like to bring to the fact that at Mirae Asset, we sit with our own market maker. So the liquidity we will provide, you can check us out post-April or for any amount. The point I'm making is for running that business, we have to up our infrastructure, which all of us are trying to build. Not only do we have to give you a liquid asset, we also have to manage the tracking error, our ability to replicate the benchmark in totality. That will also be tested as the volumes grow. And the volumes have been growing. If you look at the folios, if you look at the money flow beyond the government, on a daily basis, we are seeing that part of the business growing immensely, and that brings you and gives you a very interesting perspective, because when you look at active management, both on equity and debt, the categorization is laid out, and hence there is that much ideation that can happen there. But on the passive side, there is no limitation to the product mix that we can give you. Going forward, we can cater to your specific needs and build indexes also. It's just a matter of time. So the creativity that the passive side will bring to you, both on equity and debt and other asset classes, will unfold as we speak, and that's where probably the industry will look forward to graduating and providing brilliant solutions to you in the next 2-3 years for sure. And the product manufacturers or the product teams will become far more relevant than they were in the last 25, 27 years of the industry. But I think from the debt side, the last 2-3 years have been learnings for all of us. The destruction of the credit market on the mutual fund space is often discussed, and I personally don't think it's a bad space. But suddenly, from an investor perspective, the demand for the portfolio to be such has led to, honestly speaking, minimization of the options that we can give you. I would request you all to be a little more vigilant of that space and allow funds to be a little more creative, because not all credit is bad. At this moment, if we go beyond a certain credit rating, it is absolutely not acceptable for investors. Right or wrong, I'm not commenting, but it does restrict ideation from our end. It does restrict us to give you differentiated solutions. I hope and pray that that space is looked in a more mature manner. We've, as an industry, learned our lessons on do's and don'ts. Probably we'll come back to you with differentiated solutions there, but that space needs to be relooked or rebuilt from our side is something which all of us are thinking as we speak. But from an investor perspective, and that's all that matters in this business, because there is just one rule for us in this business: is what is right for the investor is right for us. There is no other rule. When you look at that space, the investor today is spoiled for choice, I feel. Because maybe the Indian equity markets look a little overvalued in the short run, but this economy is going from 3 to 6 trillion, irrespective of any politics. And money can only be made through the capital markets is also a reality, whether pre-IPO or post-IPO, that's a separate issue. This growth will come back to you only through the capital markets. So when you expand the horizon to 5-10 years, this 3 trillion going to 6 trillion will unfold in a very different way for the country. We've seen it unfolding. I mean, when we go to the towns, and I come from a small town called Bhubaneswar, it's practically a new city now. Look at Mumbai, you enter this thing, the entire city is being dug up. And the next 10 years, we'll see Mumbai in a very different way. When you look at the international market, I mean, you look at US available at what prices. If it is available like that for the next 3-4 years, then the world will be very different on different parameters of macro data points. The global market was never so attractive in the last 10 years. And I do believe that equity markets will give you opportunities to buy now and then, but the opportunity that the debt market is giving you right now can be very short. So identify that opportunity and then make best of the yields that are in front of you would be our submission. But before I end, my cliched dialogue of there is a risk to investing, there is a risk to not investing as well. There is nothing called risk-free investing, so just look at the risks involved well and look at imbibing those risks in your portfolios, and it's a great time to invest. So thank you so much for the opportunity that you've given me today, and really appreciate all of you coming from all over the country and giving us this opportunity to meet up with you. And have a great day. I look forward to the sessions that are ahead in front of us. Thank you so much.
Thank you so much, Mr. Swaroop, and to the entire Mirai team for bringing the vision of Family Office Summit live. May I request our next speaker, Mr. Sridhar, to please felicitate our chairperson, Mr. Swaroop Mahunti. Great. We now move on to a keynote address from Mr. Sridhar Narayan, CEO, Infrastructure, Group Director and Chief Investment Officer and Strategy Officer, Hiranandani Group, on the topic Family Office Vision. A very warm welcome to you. A big round of applause for him, please.
Good morning and welcome all. I'm very happy to be here and see house full of family office, investing guys, wealth management guys, asset managers. As I was listening to Saurabh's address, I was just thinking what I should be telling all of you today. Well, I wear different hats as a CEO for the industrial alternate asset class, also as a CIO for family office. And so it's a mixed feeling. But then the good thing is, since I've sat on all sides of the table, it makes a great opportunity to share my experience with you. And I would really, given the current situation in the country or the global economy, would say that end of the day, I've tried a lot of stuff to generate alpha. As I heard Saurabh mentioning, and I saw some brochures around of Spark, the whole idea is going back to basics and focusing on how you want to invest and how the family office perspective should be. I think most of you, if I'm not mistaken, are out here to be able to deliver on your goals and objectives vis-a-vis the family office that you manage, whether it's single family or multi-family office goals. So just I'll break my talk into 3 or 4 things that I had written down, and then I subsequently jotted some more stuff based on the profile of people and also based on what the chairperson or Mr. Mohanty spoke about in terms of expectations. I'll also leave some time at the end of it for any Q&A if you have in the next 30 minutes that I'll be with you. See, to start off with, while the global macroeconomic situation has been in a flux, the Indian economy has sort of done well. And I would say that, if you're going to close your economy with a GDP of 3.5 trillion by end of 31st March 2023. So that means there is a lot of opportunities. And during this phase, my experience with a lot of business houses, promoters, wealth managers, asset managers, mutual fund is that a lot of wealth creation has happened. A lot of ultra HNIs have been created. And as he rightly said, it is a eye-opener to see India as a country with a huge amount of opportunity by the number of HNIs that have been created. Just to give you some statistics, there was a Knight Frank report on wealth, which I contributed to some time back. Ultra HNIs of asset around $30 million have increased by 11% in the year 2021. So you can see the quantum of wealth. It's not about only the earlier days, we all got up to believe that there were 10 or 15 large global wealth creators in India and industrialists and they would have wealth. I would think the entire startup ecosystem has created a lot of wealthy HNIs who are again reinvesting their money. So the ecosystem, if you see in the last 10 years, have created huge amount of ultra HNIs. So keep that in mind. The concept of family offices has been gaining ground. Single family office, multi-family office, up to 100, 200 crores, I would think that it's not very effective. So multi-family office approach is a very good stuff. But anywhere beyond 1,500 to 2,000 crores, single family offices makes a lot of sense, as I see. And it's also very important, why family office setup or professionals, and most of you sitting out here, and maybe some promoters too, HNIs too, is it that end of the day you need to handle money the right way. It's not about, it's investing with a lot of compliance, governance, and more importantly, with the goals and objectives of the stakeholders who wants you to manage this money. The earlier I have seen a lot of promoters and including my current family office, if you are very good at some business, so bulk of your money is invested in that business, and then when you take out or you monetize those money, that's when you create family office. But there is this internal urge to be able to invest back into the same asset class where you are exposed as a business. Because the mindset is that I know that asset class very well. Be it real estate. If I'm a real estate developer, I monetize, I got $1 billion. Like I monetized some $1 billion for one of my stakeholders. And then I took out the money and put it in a family office so that I said I won't invest in that asset class because that asset class is already exposed because you've got a concentration risk out there. So that makes a lot of sense. And I could see that a lot of
professional wealth managers, family office specialists and offices trying to put in kind of, this kind of stuff. So when you write an investment policy for the family office, for the stakeholders, you have to take into account all this into considerations. Ideally, when people try to, get into different, what I've seen is a lot of people have moved away from the traditional asset class and have started investing into equity, debt being the normal stuff. It all depends on the risk appetite. Then there are REITs, then there are yield assets, there are alternate asset class within real estate, student housing, etc. Again, they are all different forms of yield assets. So it all depends on the risk appetite. So it's a risk-reward proposition that one needs to keep in mind. There are a lot of opportunistic investing, like the IPO, pre-IPO investing that happens, and that creates a lot of opportunity or an opportunistic investment mindset for people. For example, I had this real estate example I gave you when we encashed $1 billion and then we said we won't invest in real estate, but we'll invest in non-real estate assets. A pharma company promoter called me and said, I have sold my pharma company. I'm sitting on 2,000, 3,000 crores. And my son and my grandsons and my nephews, uncles and the extended family think that we should get into infrastructure and real estate. Can you come and set up a fund for me? Now, my first question to him was, I can set up a family office or a fund for you, but more importantly, the idea is what's the core competency? Where's the mindset? One is professionally investing your money, which means you go to a single or a multi-family office kind of a construct, and you have a huge amount of competent asset managers around town, and then decide. You can't blindly decide after doing pharma that because I like the infrastructure and real estate space, let me take a bet, because you need to understand that asset class. There are risks and opportunities which go with it. I'm not dwelling into what risk, what opportunity, because that would take probably the whole day for each asset class. But one needs to keep that in mind, because now real estate is split into capital gain asset, real estate is split into yield asset, a different kind of financial instruments can be where the underlying could be a real estate. There is credit opportunities that Saurav spoke about. So there are many formats in which you need to know, but underlying of all of that is basic. Please understand the asset class in which you are investing, understand the appetite that your stakeholder has or you have for that asset class, and what is your return expectation. And time, you need to have a time horizon, because liquidity buckets makes a lot of sense in this volatile market. You need to have a 3-year horizon or a 5-year horizon or a 7-year horizon. And depending on your stakeholders' needs, liquidity plays a huge role. In the olden days, like what we used to say, cash is king. You invest in an asset, you blocked. So the opportunity value for that locking in is much higher. So liquidity makes a lot of sense. So I was just thinking about, when I was jotting down. So now, the old generations have moved away from your standard asset class to now debt, equity, fixed income. Now REIT fills the gap between an equity and a fixed income. I was also contributing some of my thoughts when we wrote the SEBI REIT regulations before the embassy REIT happened. And it actually brings out the mindset of the culture prevailing. India is it's an emerging economy growing at from a 3.5 trillion, I expect it to be to a 5 trillion economy. And the next 8-10 years, I see, in spite of this global things, that it can really shine out there. And combined with it, wealth is there, economy is growing, it's an emerging, developing economy, new asset classes on the bench. It's a fantastic cocktail or a mix, but then that's where your expertise, your ability to be vigilant, sharp, and look at assets would make a lot of sense. And also, India, I think today they invested close to maybe more than 20 billion. I expect by 2026, $30 billion of investments going only to a very interesting asset class called startup VCP investments. Private investing has taken up a lot of money, and while it slowed down in the recent times because the gunpowder in this last 1 year, I would see much more going forward as we look at different classifications. So what is the outlook of 2025 from here till, say, give a couple of years here and there? I would think the number of family offices will increase given the perspective that each one of you would have, and I can see development of family offices, and with greater recognition about how to manage money being really up there, because now you have sports stars, celebrities, everyone having family offices. So as I said, it could be 100, 200 crores single family office, or it could be a multi-family office approach. Typically with corpus of 100 to 300 crores, a multi-family office approach would make sense. So if you specialize yourself into being a good advisor, good expert, I think that's going to be a big canvas as you pivot through this scenario. And if you're above a certain range of 1,500 to 2,000 crores, and that single family office approach makes sense. Like I manage a 2,000 crore family office as one of my obligations as of now. Also, I run a venture capital fund, which is a CAT2, which invests in a non-real estate. It's technology, innovation, healthcare, impact fund, ESG and impact. So in the near term, there will be a lot of volatility in the global economy. And what I wrote was in mostly geopolitical tension. You saw the Ukrainian war, commodity inflation went through the roof. I'm fortunate because, when I operate an asset, I understand inflation hitting, and then I know what returns that asset can generate vis-a-vis a financial advisor packaging it and selling it as an yield asset. So you see the entire journey from the asset to the instrument and then the yield and the return to the investor. So geopolitical equations are changing, and this will affect trade relations. Your Ukraine war has put in the US-Ukraine conflict, and then you got the China COVID and interest rates going up. There could be a recession. Europe is going through liquidity crisis right now, as I'm saying. Large funds, as I'm talking to them on different asset class, it's very difficult to write large checks right now. But do you think this is going to sustain for a long time? No, I think India is a bright spot. A lot of discussions have gone through about coupling and decoupling of India with the world economy. I would suggest that give it a year or so, then you are on the growth path. I see India's GDP growing. There is a lot of compliance that is getting fixed, whether it is SEBI, whether it is BSC, whether it is tax. And I think, unfortunately, the budget took away the MLD and zero coupon bond tax impact, and that you must have realigned your portfolio accordingly. So what is it that major equity markets have seen a correction? So I think probably there will be some more corrections because actual valuation needs to get reflected. And then while you are in the process of generating an alpha, you should always be very clear about timing and valuation. Reasonable valuations does matter. I mean, in a bull run, you obviously pick up things and then run with it. Then the frenzy takes over. But more importantly, always having an attitude of picking up things at reasonable valuation makes a lot of sense at all points of time in the market. Thus, the asset allocation for 2023 is looking like a year in which global uncertainty will continue, but then there will be a lot of opportunity, valuations will get corrected, and I would see that's a great time to, be able to retain your gunpowder and be able to invest as you go along in this marketplace. Currently, as I was talking to a lot of MNC, global treasury offices, etc., there has been a little bit of the biggest risk that they see is the investment risk. I'm talking to all of you as investors, but I'm saying the biggest risk. I used to normally say the biggest risk in life is not taking a risk at all. So, but then in investment, you have to take the risk. But then you take a knowledge-based risk. It's kind of a combination of trying to generate an alpha over and above the normal return at the same time, balancing your value at risk. It's a risk-adjusted return that you should look going forward, and especially given the current environment, that is my take, and maybe you should also look at the underlying assets much more closely than what you would look at. You obviously have asset managers, funds, but we try to go one more step and take a look at the underlying assets. So having said that, there is optimism that there will be a global recovery, and 2023 post you will see again a surge. And in that context, in the global context, India is very well positioned to be able to take advantage of that. And as I'm seeing, at least there are 300 family offices in India with more than $100 million of net worth ready to invest. That's a kind of family office thing that is there. So a few more points in terms of the diversification of asset class, tax structures, estate management, trust. All of these are the new trends. Alternate investment asset class. How many of you invest other than in traditional asset class of debt, equity, fixed income, or structured debt, or mutual funds? Do you invest? Yeah, great. So that could be what? Yield asset class? Yeah. So you do invest in REITs. Do you invest direct take exposure in an industrial warehousing asset or student housing? So these are all different asset class it's going to come up. And I can see that growing because not only I'm on the operating side, but also on the investing side of this business. So it makes a lot of sense for you to take a look at that. But for that, then you need to be approaching those asset class with a clear understanding of the underlying. So now startups account for nearly 60% of domestic capital raised in 2021. 60%. So I see a lot of HNIs, family wealth, all investing in venture capital, private equity. And some of them also do co-investing and directly invest. So what has happened? There has been a change in the mindset in terms of trend from the old traditional asset class to new asset class. The new generation of the family, the second generation, third generation, are willing to take a little bit of, they have a different view on the risk-reward proposition and want to create more value. And they understand technology. So digital transformation has played a key role. Now, any investment that you make, we would like to see whether that business is asset light, more technology, more innovation. Because end of the day, every asset-heavy balance sheet takes away a little bit of return. Or any idle cash living in a balance sheet also takes away the return. It corrects negative IRR. So impact investing and ESG investing, like Saurabh mentioned, that's been a very interesting phenomena, and I think that's going to be social commerce. This is going to be attracting a lot of investment because a lot of family offices see a lot of value in it. Cross-border investments, geography in which you invest will also make a lot of importance. So I won't stress more on governance, due diligence, because I think that's imbibed by all of you in your process. But more importantly, I would request all of you to look at liquidity buckets, time horizons, and expected rate of returns that you would look at, and then start looking at your different asset class. Because once it fits into your philosophy and you write your investment policy accordingly, then it makes sense for you to invest your money like that. So what is the investment strategy? I want to conclude by saying that what is the investment strategy that one should follow going forward? I'll keep it very simple. To succeed, a family office first has to understand the objectives of the stakeholders of the family office. So this I discussed the key trends. So they had to understand the core objective of the family office. For example, when I was a chief financial officer of Britannia post takeover, I played the interest rate curve on the yield. I'm just talking about 10, 15 years back, and then made 33% of the company's profit came out of the treasury profits. Now that's a bet. But now Britannia at that time was a 2,000 crore top line company. Today it's a 10,000 crore. Varun Berry, my good friend, runs a company from Pepsi. I was with Coke earlier before I moved to Britannia. So the whole idea is that how do you leverage your balance sheet? So idle cash, instead of lying, you can convert that into an opportunity and then create value. So obviously it has an impact on the Britannia stock. Now it's obviously gone from 5 times from the time that we have looked at the stock. So that's a great story. So if you have the ability to pick early picks and then do those kind of stuff, that's interesting. So the idea is that you should have a balance between earnings, risk and reward adjustments. And few principles that you need to follow is where you protect your principal, then you look at your return, then you look at your alpha, then you say what kind of risk-adjusted return that you're expecting. Please do that exercise, whatever the instrument is. For example, I read the rating agency report, I look at the underlying post the rating agency report, and then I take a call on investments, pure investments from the family office. Obviously looking into the way, how much of risk the stakeholders have the capacity to bear. So, but at the same time, keep 25 to 30% or maybe more than 30% in the current environment for opportunistic investing in different asset class, which will give you the alpha, if you really proportionate the whole discussion. So to conclude, I say, while we in life say in the long term, all of us are dead. But in investing, you have to invest with a timeline and phase of the timelines that you want. You need a 3-year timeline horizon, 5-year. So don't use the same logic of in long term all are dead, because the moment we put a lot of things into long term bucket. And there is a tendency in most of the managers that I see to forget about what happens to the asset class if you're put in a 5-year, 7-year bucket. Then there's a lot of market events that happen and that impact, like your credit risk happened, Franklin Templeton had a problem. Not to blame them, but it's more that the market event happened with all financial services, credit risk happened. So it's very important to time your investment and adjust your risk-adjusted return accordingly. So India's growth story remains invest at reasonable valuations, look at, focus on the operational excellence of the asset that you're investing in. That's my keyword, operational excellence, value proposition, risk-adjusted reward. I think I cover most of it, but it has to be more detailed when I say. And if you look at that, you should not normally go wrong. I mean, you still can go wrong because there are market events that may happen, but you should not usually go wrong. So 90% of the time, if you have targeted a 12%, 15%, you should achieve it. Like I have targeted a 14 to 15% in equity bucket over, it's not 5 years, it's a 10-year bucket. So you booked some losses, you got out, but then you have to time so you can never time your market. So you should need to have a strategy for it based on your risk appetite. So with that, I would like to conclude saying, in the long run, we are all dead, but in investment, we are not dead because you'll be held accountable for what returns that you expected in 3 years, 7 years, or 10 years. Please keep your bucket and keep your approach very clear and understand your asset class. I think plethora of opportunities is going to come, pre-IPO, post-IPO, REIT, alternate structures, alternate asset class. It just needs for you to be there then and grab that opportunity. So store away some money, be in cash for some time, and always I would recommend look for risk-adjusted returns instead of plain base return. Thank you very much.
Thank you so much, Mr. Sridhar. Big round of applause for him, please. Great. We now move on to the keynote panel. May I invite our moderator, Ms. Priyanka Srivastava, to felicitate our keynote speaker, Mr. Sridhar Narayan. Great. We now move on to the panel session. The first topic being on the market challenges for family offices in managing portfolios. Please join me in welcoming our moderator, Ms. Priyanka Srivastava, a Vice President, Family Office, Srivash LLP. Members accompanying her on the panel is Nidhi Sharma, Head Family Office, International Tractors Limited, Mittal Family Office, Virendra Acharya, CIO, Bimson Family Office, and Anjali Dave, Head Group Treasury, ACG World. A very warm welcome to all of you. Please, a big round of applause for welcoming our panelists.
Good morning, everyone. So thank you, Sharon. And it's a great pleasure to be here in the panel and share and discuss the topic today, what we are going to discuss today. And it's a privilege to be here with people of great experience who are managing family offices. So I welcome all the panelists here. So when we talk about the challenges which are faced by the family offices in managing the portfolios today is not only restricted to the investments, but it goes beyond that. So today's discussion will try to touch upon those topics and throw some light and experiences what we have on that. So when in India, particularly if we talk about the family office concept, it is at a very nascent stage. The presence of the family offices were obviously there from the royal families also, but it was in a very unstructured manner. So from past 10 to 15 years, what we have seen that family offices have evolved, and especially when the second generations which have come in the businesses came back to India and they understand the concept of family office more clearly when they came back from US or have studied abroad. So then it taken a shape in India, and then we have moved on from the unstructured to a structured family office concept. So when we talk about the asset classes which are more suitable to the Indian family offices, so first we will try to see what are the asset classes and how the diversification of the risk is being done. So if Nidhi, if you can share your views on that.
So Priyanka, as such, the topic of diversification itself is quite elaborate. The way we like to look at diversification is through a threefold approach. One is looking at the philosophy of the family, the kind of vision they have for the money, and the kind of longevity they have of the money becomes very important when we are defining asset classes and the investable universe as such. The second is to construct something like an investment compass which gives us a vision or some sort of risk return matrix or as to the kind of return expectations one can have. And the third would be finally to define diversification as a means to mitigate volatility, which is very important, rather than looking at it from a lens of growth capital. So these are the three ways we define it, and how that helps us is that over a period of time, when there are certain drawdowns that come, the family itself is very comfortable within the scope of what they have defined. So diversification to equities, fixed income or other asset classes needs to be an exercise which one constructs or reconstructs over a period of time. As such, currently as we speak, there are a plethora of investment avenues which are available, along with pure vanilla products which are available, and 5 years back, 10 years back, there were not so many options available even in the alternate space. Today we have venture capital funds, we have venture debt funds, we have private equity, we have a host of long short funds also available. So the definition of diversification to my mind would also be to look at it as a mechanism of the underlying risk and trying to mitigate that. So today when everyone talks of inflation, is there a way we can diversify wherein we try to control that to a certain extent or try to mitigate it in a certain manner?
Just to add to what both of them have said, what we look at, or another way of looking at diversification is in terms of the complexities. Rather than look at risk and volatility, look at complexities. What's happening is that today in the market, if you see last couple of years, a lot of complex products are available. In India, they are at a nascent stage, but with the push from the manufacturers, unfortunately, a lot of these are getting carried forward in the form of factors. So one is to be quite wary of the complexity and whether the complexity is giving rise to the adequate returns or are you compensated from that. So diversification, another way of looking at it is in terms of the returns that you're getting and as well as on the complexities of the underlying instrument. Is it worth going for the complexity? And at the end of the day, you're going to get a return which is similar to what you would do. Secondly, what we need to avoid, what we would say is that don't diversify for the sake of diversification. That's something, like as Mr. Sridhar said, it's better to keep it simple rather than keeping it complex. So that's something I would say.
So both of them has very much covered the area of diversification. One point I would like to add here is that it also depends upon the risk appetite of the particular family office or the group. So ideally, you need to have a very, very detailed risk management policy. You need to understand the liquidity needs. Has rightly put up, there are multiple products today in the market, but therein comes its complexities as well. So it's very essential to understand all the products, what exit cost they offer, and that way build the product, not making it very complicated, but keeping things very simple.
Yeah, rightly said as about diversification, that it's actually a matrix that's been even derived from the risk appetite what's being taken by the family office or the IPS charter that has been given. In particularly post-COVID, do you see any changes that on the diversification side or any thoughts on post-COVID scenario?
So I would address this question a bit differently. What COVID provided, COVID is one of the opportunities, I would say. Always the risk comes in one shape or form. It was COVID, followed by a jump in the oil prices, followed by Ukraine, Russia war, multiple. The risk keeps coming. What is important as a treasury person or as a CIO is to identify the opportunities that lie within. For example, last 2 years, your debt did not give any much of a return. It was very submissive return. But today, the debt opportunities are enormous for two reasons. One being the yields have hardened and the real return has turned positive, which was not there 2 years back. 2 years back, your equity would have provided you a good entry point. So this crisis should be looked as more for an opportunities, and we need to do our homework quite well so that we are able to seize this opportunity when it presents itself. So I would rather look these events as more of opportunity than anything.
Yeah, absolutely rightly said. So, when we speak about a risk in any of the portfolio, that means we are talking about something of a market risk. And when market risk comes up, it is a systematic risk, what we call in another way. So, how you individually see and manage the portfolio with the volatility?
So frankly, there is systematic risk with everywhere and anywhere. How you manage this risk is of paramount importance. So when you build up a portfolio or a construct of a portfolio, you need to understand in very detailed manner the needs, the liquidity needs, the risk appetite, and the three main pillars has to be safety, liquidity, and returns. These three synergies, or this three trinity, has to be managed very well.
Yeah, absolutely rightly said. And Nidhi, how you manage the volatility in the portfolio, if you could just throw some light?
Yeah. So I certainly believe that, see, in any portfolio, volatility should be intentional. It should not be a surprise. So in the beginning of the year or while making the investment charter, when we define the kind of asset allocation that we want or the kind of risky assets we want to be in, this is a volatility that we are building into a particular portfolio. So in times when the tide turns, this should not be a surprise, and hence behavioral finance also comes into play.
Yeah.
That what is the kind of comfort you derive from the drawdowns that you can expect, going forward, and these need to be, stress test various times at different cycles at different junctions, and it needs to be systematically also shared with the family, or within the family, the kind of comfort that they get at certain asset classes. So if one cannot digest the volatility, one should not be in such asset classes. But volatility should be looked at as an opportunity, like Anjali rightly said, that volatility is not an enemy, risk is not an enemy. It has to be intentional for you to take full advantage of the opportunity that volatility presents.
Just to add to what they have said, I think we need to first understand that every asset class will have some volatility. Normal tendency is that when you invest, people tend to forget that every asset class could be volatile. Now, if you are aware of, or if you start at the beginning itself, you are aware of that this could be a drawdown or this could be the probable drawdowns. I mean, it may not happen, but at least be aware of it. I think most of the work is done, because nobody likes surprises, especially the bad surprises. So I think, just to add that, we need to identify the risk and the volatility at the beginning itself.
Yeah, rightly said. Yeah. So if we talk about market risk, obviously we are referring to your equity risk, we are referring to interest rate risk, we are even referring to the currency risk. So I think all in conjuncture to be looked at while devising the portfolio, and accordingly the asset allocation should be moved from that. So I think we all are currently following the same strategies across. So now coming on to the investment trends, if we talk about how the markets are behaving. So very interestingly, as Anjali has initially mentioned about the fixed income. So in the rising interest rate scenario, how you look that, we can easily say that it is much easier to decide the deployment currently. So how you look at it, and have you increased the allocation from equity to debt, or what are your thoughts about it, Anjali?
So today, debt market is providing us with very interesting opportunities, be it on the duration. If you see the yield curve after the aggressive rate hikes by RBI, the yield curve has become flat. In fact, there's a sweet spot between the 3-year, 5-year, and in fact, if you stretch up to 7-year, the yields are much better than what they were pre-COVID. So this is the spot, this is a 3-year, 5-year bucket is where we are placing our investments currently. And because of the hardening of yields, the yields, YTMs are also looking very attractive. Credit is also a space we have explored and we'll continue to explore. If one does a proper due diligence and there is a good risk reward to be made in this space as well. So this year, surely this year is a year of accumulator in case of debt portfolio. We have not overtly stretched ourselves in debt, but whatever opportunity it presents, we are going to pick it up. One more I would like to add, because of the new changes in the budget with regards to the MLD portfolio, you suddenly are presented with multiple short-dated paper with a very attractive yields. So that is again, it helps you to meet your liquidity requirements in the short term because they're short-dated and you capture the hardening of yields. In addition to that, while right now equity where we all said it was very expensive at 18,000 plus levels, so there's been decent corrections in the equity market. We also see these corrections have helped the most of the stock to become properly priced. So in the second half of the year, we think global markets would also kind of come out of the recession, and that would also help this current positioning of equity market into second half of the year, financial year, will give us good results. Right. So we have not increased, but we have continued to keep the same allocation.
Sure. So how are you constructing a fixed income portfolio currently?
Yeah, so currently over the last 8 months or 9 months since we saw the rates peaking out, we have gone long duration. By long duration, I mean we have even gone so far as 8, 9, 10-year bonds. And we have increased the duration from 0.75 to almost say 4, which is quite high.
Yeah.
But again, it's a bet. And it's a calculated bet given where we are in the interest rate cycles today, whether it is globally or whether it is in India. What we are looking at is that rates are almost near the peak. Another say 25 basis points in India, maybe another 50 basis points in US, post which we are expecting that the rates will stabilize for a period of 6 months to 8 months, and then from there maybe a consolidation starts. So essentially here the difference also that we need to see in fixed income is that the carry that you are getting. When we started building this allocation, the carry component in say a 10-year was around 780, whereas ultra short or a short was around 6.5.
Yeah.
Today that gap is flat. So at this point, if I am to invest, the 4 to 5 year segment looks very attractive on the curve, at least in India. But having said that, globally also the trends that we see, and when we see yields in the US markets, it's a very good time to invest if you have a vision of at least 2 year or 2, 3 year kind of money that one can deploy. So interestingly, there was a study conducted by a global fund house on family offices globally.
Yeah.
And there, they asked the managers of the money to define their strategy for the next couple of years as to how much they would like to keep in balance, how much in conservative, and how much in growth. So to elaborate on to this point where we talk of investments into asset classes like fixed income, 20% was defined as growth, 50% balance, and the larger chunk of it was defined as conservative. So 30 to 35% is still conservative, and fixed income continues to be the preferred asset class for investors in India as well as globally, specifically now with where rates are. So I think it's a very good time to build duration in case people are still waiting because nobody can catch a cycle end to end.
Absolutely.
We need to pace it out, we need to space it out. So till March, I think it's a good time to add duration.
Just to add, what we have been doing is that we have been following the laddering approach, because if you get into a 3 year, we have always the problem of reinvesting at that point of time. So we have been bucketing it up 3, 5, 7, and playing a mix of the duration as well as the target maturity funds. At the same time, keeping some amounts in the low duration for which we can take advantage of the opportunism in the MLDs. Today if you see MLDs maturing, we can get upwards of 8% up, and So we have been playing that because this has been learned in the past, where in the past we had most of the maturity at the same time, and unfortunately for us, they were in the 2000 period, 2001, and the reinvestment, we ran a huge reinvestment risk because the yields at that time were they were below inflation. So having learned from that, we believe that laddering approach is much better. Yeah, we will not catch the entire cycle, but as I said, having less volatility also is equally important for us.
Yeah, absolutely, Virendra. And the same the thought process we in our family office are also following. We are also laddering it in the buckets. We are not concentrated only on the long duration, but yes, we are consciously laddering it over the years, and so that at least, because we can't predict the cycles, right? We don't know how it's going to play out. So I think that's the takeaway on the fixed income side. So now, if you see on the post-COVID scenario, there is a huge deal flow that is coming in on the unlisted space also. We are seeing a lot of opportunities coming in and good bargain. So, and I'm sure each of the single family office would be getting about 2 to 3 deals in a week, if not, just to say that. So, how is that being looked up, and is there anything on that allocation that specifically you as in house, you guys have added onto that bucket list?
I'll take that first. Yeah. So just to give an example, we've seen post-COVID a lot of deals happening. In the last one year, this is the funding winter started, there are too many of them. Now we look at it with skepticism, is that when somebody reaches out to you directly, that means they have exhausted all their avenues of raising money. So you need to look at it, right? And if the company is good, it's a hard time to bargain. But at the same time, all deals coming to you is also a sign that the winter is getting longer in the market. So you need to be wary of that. So we have been taking a very opportunity approach here. But as you said, the deal flows are much more than 2 or 3. We're getting much more than that. But this is a time to be cautious rather than jumping in, because the same companies about a year back wouldn't have looked at you at all. They would be more interested in going in the larger funds or other thing. But when they start approaching to you at individually, it's also a sign that the winter is longer, especially in the unlisted private early stage post Series A type of investments.
Very well put up, Virendra. The winter is getting longer. So we also evaluate the private equity space, but special focuses are given to the offers wherein we have synergies with our existing business. So that can be looked as an extension, or more than just a financial investment, can we have a strategic investment. So that is the approach we adopt. This is the first layering, and of course then the valuation and other factors follow. But there are some good businesses which are proving to be disruptive, which are addressing to the many of the challenges that current market is throwing up. So those are interesting offer, but everything should come at a right price. So the more focus is on that as well.
Yes, absolutely. As the valuations are actually coming more to realistic, then obviously there are good opportunities in the market that can be looked upon and allocation can be worked out.
No, I would, agree to the points that both of them made. Just another 2 cents on this is that, history has taught us every asset class has cycles, and in every quarter, every 6 months, something does better than the others. So for the last 1.5 years, we were consciously avoiding the space. Given that the valuations were so exceedingly high, we were okay to stay away from the space for a little while, just to reassess where we are standing currently.
Sure.
And now that we see that valuations have reached some level of sanity, we are not keen to explore. However, in the last 3 to 6 months, we have not consciously added more into this. We are, building onto this asset class a little more gradually. But yes, now sanity is prevailing, so this becomes a little more attractive. Along with this, other investment avenues on, say, venture debt or venture credit funds along
Yeah.
with private equity. There's also over a period of the next year, I envision will become more attractive for investors rather than somebody would have invested, say, about a year back, where a lot of pain is being seen now. So yeah, broadly agree with what the other panelists have said.
Great. So, and as you specifically said, Nidhi, about the VC and the PE space that looks now little lucrative, that's gonna coming year. So, how's the allocation that you guys are looking for, or as an opportunity, if you're looking? So, you have increased the allocation, or it is already in the bucket that's in the IPS been carved out. So, just
Yeah.
you would be deploying and triggering the gun now.
Yeah. So, yeah, great question, Priyanka, on this, because see, earlier the investment policy that we had was restricting it to close to about 10%. But we had not utilized this completely. We were keeping some gunpowder towards the end, and we'll be utilizing that. So the way we define it in our investment charter is that every asset class, suppose, has a 10% limit
Yeah.
or a 20% limit. There is always a trigger for a 5% tactical allocation,
Sure.
which one can use if the opportunity is really great, or we see that this is a great call to take at this point in time. So as such, right now we do have some gunpowder left, and the 5% trigger that we can utilize at some point in time, we are keeping that as well.
Yeah, because this is what is a very typical,
Yeah.
that allocation, as in the IPS, I think all of us would be having an allocation, but I'm doubtful that 100% being deployed. So that is something which is I
True.
was curious to know.
Yeah,
So,
absolutely.
yeah. So, and coming on to the investment avenues which are there. So we have a traditional vanilla products as well as on the various alternate investments what we have. So, how you guys see in the current scenario? So you are sticking to the vanilla itself, or just on something new you're trying, sort of?
So we have allocations to the regular vanilla long short funds. But today, if you see AI space has exploded, there are multiple opportunities that being thrown up. And if any specific investors are looking for any specific sector specific AIF category, even that is possible. But as we have made a conscious decision of restricting ourselves to only few of the AIF, which are something like structured debt or long short funds. So these because here what happens in AIF, there is always an extension. It's quite, in certain cases, it becomes quite opaque.
Yeah, absolutely. And if you see the scenario, especially to the hedge funds in India, so it's very nascent stage currently. So as a family office, so we look out for the offshores because they are much more, experienced fund managers who are there. So that way, I think it will grow up in India also, and then maybe, better
Yes.
managed hedge funds will also come. So that's something
that
apart
maturity,
from,
that
yes,
mature market
yes,
is still on its way
it's
to
on its
India.
way.
I
So
think for us, it's still 80% is the plain vanilla, and I mean, it's the boring one, but I think we still have a small bucket for the private space and the new things, or maybe a green bond or something like to try out. But I think the core will continue to remain, the philosophy has been continued to remain, keep it simple,
Sure.
the core. And then if you make some returns over there, maybe those spillovers can be used for some experiments. But today, I mean, a lot of things are available, but I mean, it's again, as I said, the complexity is increasing. We don't know how to evaluate those managers because a lot of things are new. So, I mean, we would rather wait for some time, to see maybe a couple of years and then.
So, from my side, Priyanka, what I can say on investments in vanilla versus alternates, see, currently, the way we see these two diversifications and where we are today, 4, 5 years back, 10 years back, there were not too many avenues available for us. Today, alternate space also gives us avenues to improve returns on what we have in the vanilla space. Something like a index investing can be a very vanilla thing.
Right.
But today we have avenues in alternates which can help us, say, generate a little bit better alpha than what we are doing on the plain vanilla. So I think that in itself is a great opportunity. As such, vanilla will always remain a core part of most portfolios, especially at a time where we are today with rates being where they are, with the equity markets being where they are. and risks which are looming large on recession or global markets. So I think most people would like to approach portfolio management with more conservation than extremely high aggressive sort of allocations. But yes, alternate space which helps us improve vanilla kind of allocations is something I think is a great opportunity at this point in time.
Right, very rightly said, because as all of us have spoken about vanilla versus the alternate, so it looks like core will always be on the traditional products which are there, and then new sort of products can be tried through the alternates. Now, quickly, we will just touch upon the regulations and the technology part, how you've been, what challenges you've been facing on reporting of the portfolios and the change in the regulation that keeps coming in. So if you could just
Yes, we need to always keep a very close watch on the moving regulations because there have been multiple changes. And it definitely impacts the portfolio. And being professionally managed, it's our core responsibility to maintain that governance and continue with the requirement. So yes, technology has helped, but it's very, very important to stay very glued to the changing market regulations.
Sure.
Just to add to what she said, I mean, while the compliances are increased, the bigger challenge is, on terms of the dashboard, in terms of reportings, because the different asset classes have a different way of reporting, and to get them in a format which the family wants, it's a bigger challenge, I think everybody of us at the back of our minds is still old gold or Excel, which helps us.
Yeah.
But I think as the portfolios grow and as the complexity increases, I think this is something which we're looking for. I mean, if somebody has a solution, more than welcome to connect directly. I mean, so that's something grappling with.
I think each one of our, that's something which is bothering, and I'm sure people here would also be facing who are managing it, because see, effective communication comes when you have a very free flow of the data. It's like you're on a one click. So I think, as I said, we all are at a very nascent stage and evolving. So we are even finding the ways, like in-house, what we have done at Shivansh is we are developing our own dashboard. So though, because the products available in the markets were not able to suffice us. So we are in-house in building it with a team of the developers and, one of the firms helping us on that. So I think that's something which will obviously come up in future. And I think maybe similar something you guys are also following at your office.
Yeah,
right?
absolutely, Priyanka. So, technology is something that none of us can now ignore.
Absolutely.
Given the scale and the gamut of products available, given the kind of reporting structures which are there, some returns which come quarterly, some come daily,
Yeah.
some NAVs come daily, equity markets is daily. So, how do you amalgamate all of this? And with, in my firm, essentially, we are managing 20 family portfolios of 3 generations.
Wow.
All of them will have very different kind of structures built into the portfolios. It is virtually impossible to do it on an Excel now, given the scale. So what we have done is we have also partnered with a technology platform, and we have got a customization done through them.
Yes.
For this kind of portfolio reporting. Of course, it brings us to better efficiently managed dashboards, lesser human errors and things like that. But yes, as a growth and evolvement of family office, most of us are now focusing on to building more model-based approaches. And given the trends that we have seen in the past, I myself back in 2020, I've done a course on machine learning, just so that I can scale up the kind of learning that we can develop in the family house, in-house, for our own research.
Absolutely. I think the topics that we discussed today were of immense knowledge, and it was a knowledge sharing great platform here, what we have sat and discussed about. So to conclude that, yes, we can say that there are various challenges which have been, on the managing of the portfolios of the family office. But with evolution, with the communication that in India specifically the single family offices are having with them on, on the different platforms like the platform like this or some other. So it's easy to build up a community, and we look forward to a great future, and hope that we all will come out to be, more practiced and more efficient family office managers in future. Thank you.
Thank you.
Thank you, Priyanka, and thanks to the panelists once again. We now move on to our next presentation on the equity market outlook. Please join me in welcoming our next speaker, Mr. Nilesh Surana, CIO Equity Mirae Asset Investment Managers Private Limited. A very warm welcome to you, sir.
And thanks for coming here and giving us an opportunity to interact. My name is Nilesh Surana, and I have been associated with Mirae and as CIO on the equity side. So I have been, Sanjay has given me 20 minutes. I don't know in 20 minutes where we can reach in the presentation, and such an august sort of audience. So I'll try to quickly give sort of bucketize into three parts. First is just medium-term outlook on the market. Let's say over next 2 years, or maybe in this year, how do we see the trends? And next is more longer-term, 5-year plus view on economy and markets. And third is more on fund-related sort of positioning. Actually, this was the agenda, but we can't go in detail. I mean, we'll try to sort of skip few slides and focus on the relevant part. Just to give a context, I think since last year, 2 events happened, all of us are aware. One is there is a rate change regime or regime change in the interest rates or end of lower interest rate regime. All of us know about it, what's happening in US, and that's driven by multiple factors. It's driven by, we'll try to cover that. And second is on the energy basket sort of moving up because of the war. When I say energy, it is all oil, crude, gas, and coal. I mean, that impacted our current account and multiple factors. These were the 2 things, of which the second part has sort of come off in the sense like there is some respite. But the first thing is sort of obviously remaining, and that has multiple repercussions on market. Interest rates are very important for valuing any asset class. You guys know it very well because the cost of capital is a function of interest rates. And any asset, whether you buy a house or anything, you have to basically look at the cost of capital, which is sort of interest rates. And equities are the longest duration asset. So to some extent, obviously, it has a bearing. Before that, I mean, just to recap, we are seeing markets from the highs have come off by 8-9%, Nifty from 18,800 to about 17,300, and maybe about 4-5% in the current calendar year. But as we look back, I mean, obviously, Indian markets have been doing very well. And there's some context to that, why we are seeing selling FI, selling India, and buying China, stuff like that, because we have done very well on a 12-month rolling sort of basis. And the only point I would like to highlight is on the right-hand bottom chart, the 10-year paper is down 16%. So it's a havoc. I mean, since 1960, it has never happened in a period of 1 year or 10-12 months. We have seen such a sharp fall in the bond prices in the 10-year. And that is what I was referring to, the interest rate change. And as we speak, the latest IMF forecast, India remains the fastest growing economy despite the ongoing sort of global chaos. And as you see, it is like last from October to now, latest, what is the relative change? And everywhere we see India is fairly stable, and other markets, obviously, we are seeing literally a bit of recession in US and Euro area. Same is a 5-year forecast of IMF. It clearly shows, and it has repercussions when we go further ahead, that India is the fastest growing sort of economy. Just a couple of points on interest rates. It's a very complex subject. On US, it's been driven by 2 things. It's driven by inflation, and it's driven by end of quantitative easing to quantitative tightening. And inflation is what has taken priority mid of last year. It touched 8-9%. I think it's equivalent of 20-25% in India, that high. So everything was set aside, and the Fed focus and the government focus was to rein in the inflation. My two bit on that is what is happening in US is initially there was good inflation, then there is services inflation driven by sticky labor inflation. If you see last month data, the jobs created were north of 518,000, despite the increase in the interest rates. I think there is a genuine demand-supply gap for multiple reasons. One of the reasons also has been since COVID, a lot of people have sort of retired, not come back to the workforce. And the immigrant population, which used to come from Mexico and nearby countries, was not fully reverted. So the core point is that US inflation drivers are totally different. I mean, India, we don't have shortage of labor also. So it's clearly driven by shortage of labor, and they want to increase the rate. It's an engineered slowdown. They want to increase the rate so much so that you create unemployment. And the point I would like to say is, one is it would happen over time, because at the end of the day, inflation is also YOY. And second is India's driver for inflation is not correlated to the core problem in US, which is sticky labor, sort of more demand of jobs and less sort of supply. So I think net, I would say that in India, whatever RBI or the economist Bloomberg sort of forecast is by and large, as I was saying, then inflation is a YOY number. March onwards, you will see cooling off. Next year number is around 5.5%. So it's sort of fairly with base and with fallen energy basket. I think it's probably the worst is sort of over. My personal view is that 10-year around 7.5 should sort of peak in. There's a rate hike pending, but 10-year may not necessarily sort of reflect that. See, we have seen over the last 20 years that market returns are not necessarily linked to higher interest rates, because also depend where we are in the growth cycle, where we are in the recovery cycle. Just one point on the second part, that all oil, gold and gas, they went berserk, and that hit us very badly. And if you could see from the chart, there is a massive collapse of all the prices in last few weeks and few months, and that's sort of giving a bit of respite. See, while we look at only oil imports, there are a lot of things. As a fertilizer, basically is conversion of gas to ammonia, so it directly, indirectly impact that. And obviously coal also we are importing. Unfortunately, despite having so much reserves, we are sort of importing. At one point in time, for the same volume, the bill increased by 4 billion per month. So all that put together put a lot of pressure, but this is sort of behind. And this is purely because of war and because of supply disruption. I'm not going into the math of it, but that is what. Despite all these background, the economy is doing well. I mean, some high frequency, large indicators you look at it, because these are collective indicators, GST, e-way bill, energy consumption, credit. I mean, it's literally all of them are on a 3-year base, CAGR, because 3-year base is important, because COVID happened in between, is in double digit. One may argue why it's sort of happening. I think now coming to the medium term trend, I think there are few factors. I'd like to call out some 6-7 factors why economy is fairly resilient and would remain resilient. And many of these points which I'm going to say is a simple case, the base is low. Auto, since 2019, the base has been unfavorable. So all else being equal, the favorable base would help. Rural is, the base is sort of favorable. And very quickly, I'll run through it, is on the manufacturing side, of course, here again, the base is zilch. There is nothing sort of to that. But this is not so much short term, it's more medium term sort of trend. But the point is, we have seen, all of us know about China Plus One opportunity. There's a massive $300 to $400 billion of opportunity where purchasing manager will de-risk for China for multiple reasons. One is their cost of production and labor has sort of increased. By the way, globally, US, Europe, Japan, China, everywhere the population, working age population is shrinking. So that obviously has an impact on the wages. Second is government has capitalized it through PLI, through income tax rebate, and offers a lot of ease of doing business, etc. So I think, as I said in the title of the slide, is now or never, because we recollect about 20 years back also, there were noises that India will become the textile hub and all. We didn't as much sort of capitalize on that, but a lot of things have changed. As I said, China plus one clearly is a big sort of opportunity. As I was coming, I just read a Bloomberg news clip that Foxconn is also putting in additional new $700 million Apple iPhone sort of production facility near Bangalore, which is on a 300-acre site. And by the way, just to put things in context, already Apple export is $2.5 billion. We are not even 5% of what they source from China. So the opportunity is massive. And we have seen some traces. I talked about electronics, and we are seeing some traces of it. Let's see how things evolve and how the execution happen. But as I was saying, that it's clearly the base is sort of favorable to put a new engine to growth to sort of India. Autos, I mentioned, for multiple factors, the cost of vehicles have increased. Earlier, you used to get a two-wheeler at 40, 45,000. Now, nothing is available below 65,000 because of GST, NBFC crisis, supply thing, the norms changing, etc. So I think the reversal has already taken place in CVs, in PVs, and two-wheeler is yet to sort of happen. Housing cycle, again, the base is favorable. Here there is a recent bit of hiccup in terms of rates sort of increasing, but long way to go because residential sales are very, very solid. And we are seeing that the affordability, X of what happened to interest rates in terms of benign home prices and income level increasing, those vectors are intact. Rural is not doing well, but I would look at it as glass half full because one is the income level is good. We had 4 consecutive years of decent sort of monsoons. And I think rural was impacted by COVID much more because the second wave, essentially rural is not necessarily agriculture. It is also non-rural jobs. People go to urban areas to work, and that got time to sort of get implemented in terms of normalcy coming on the construction sort of side. And obviously, that's an election period is starting. I think next year is a mega event. So to that extent, government support will be there in terms of accelerating a lot of programs. So I think, and all else being equal, the base is sort of favorable. Here, only thing is now, last few days, we are hearing about El Nino, a possibility. So let's see how it evolves. February, I was told, I read somewhere that was one of the hottest month over the last multi-decades. The other point, not in a particular order, is that, which is relevant what happened last 3-5 years, is in each and every sector we are seeing massive consolidation, where strong is getting stronger and weak is getting marginalized. Strong generally happens to be larger players. So to that extent, where it is larger sectors like banking, NBFC, steel, telecom, we have seen it's now a 2-player market literally. Real estate, we don't have 60,000 developers. Do we need 60,000 developers at first place with RERA and all those sort of happening? And particularly those sectors like pipe, cable, footwear, where or plywood, all these where the unorganized is very, very high, whether it is Morbi in tiles, whether it is Jamnagar in plywood, or footwear, of course, 60-65% is unorganized. So we are seeing that shift happening massively, which doesn't get captured in GDP. That's an important point. Whereas, let's say, a profit pool of top 2,000 listed companies or 2,000 listed and unlisted companies is increasing at the expense of unorganized sort of players. So I think net what we see is that corporate profitability is also sort of improving, and the balance sheet is very strong. We have seen almost 60% reduction in debt to equity, absolute debt to equity over the last 4 years. So I think with that in background, that is important that despite the headwind of global recession and higher interest rates, because we are halfway through in the upturn, the earnings momentum will be intact. So we look at the pace of the earnings growth. Even if I take FY23 as a base, we are seeing decent growth happening this is for the Nifty sort of companies. And because the profit pool has increasing, let's say from 4 lakh to 8 lakh plus over a period of 4 years, this will have a ripple effect on capital expenditure over a period of time. Just coming back to market, I think the important number which is missing here is FY25 EPS, which is north of 1100. Let's take 1080, 1100, around that. So we are about less than 16 times PE multiples in terms of, I think here would have been the PE multiple. Sorry. So we are at about 16 times, 18.5 times FY24 numbers, which is next year, next year. But generally, September onwards, we'll see FY25 number, and that is about 16 times. I think it's reasonable. It's not dirt cheap, but it's neither so expensive. And with the correction last from the top almost 8-9%, I think it's become fairly reasonable, and that at least the market should give returns in sync with the earnings growth. That should be the minimum returns, and we have seen that the earnings growth being fairly widespread. Again, on the valuation, last thing on flows, all of us know that FIs have been selling. I think last year selling was about $17 billion, and this year again $4 billion, and domestics have bought in. This year the difference has been that other emerging markets have got money, whereas India is the last 2 months has lost to whether it is Taiwan or any other emerging market. And one of the reason has been that, I had to run. so one of the reason has been that we are not getting money in the emerging market funds, so they are selling India, which was at a 20p, and buying China, which was at 8p multiple. There is a big picture. I'll just take 2 minutes. I don't know whether it's possible. But I think this is a 10-year view or few decades view. The pillars of growth has been demographics, potential in infrastructure, and which is lubricated by reforms. Huge, all of us know about the demographics. Our median age is 28, would remain that over next few decades. Our population growth will increase till 2070. We would remain young at 2050. We have urbanization trend of about 1.5% a decade. We have more women in workforce. Age cohorts are favorable. And it's a separate topic, but we need to provide a crore job every year for next 10 years. So all in all, demographic is what attracts foreigners and what will drive this GDP growth. The second is on the infrastructure side. Even Mumbai is starved of infrastructure, a long way to go. Two pieces which I have missed, not in this slide, capturing, because is the potential on the manufacturing side, which has been missing because manufacturing is only 16% of the GDP. I mentioned about China plus one. That could accelerate, one is that. And potential on services export X of IT services because of COVID. So all in all, and of course, the digital stack, I can take another half an hour to talk about it. There is a 850 crore transactions per month are happening, which is more than China plus US put together in terms of digital transaction. So massive success story, and we have whatnot ONDC success, and obviously UPI is a case study in last 7 years. So I think that's about it. And I don't know how many of you directly invest or family office invest in stocks or so. You can take probably, if there is a time for questions, we can touch about our investment philosophy and the sectors which we like. I would not be culprit of spoiling the time sort of discipline. So I would pause here. Maybe Sanjay can give me some time for Q&A, or we can sort of move ahead, please. Thanks a lot. Thank you.
Thank you so much, Nilesh, for that session. We now take a quick coffee break. We will start the next session at 11:50. Thank you. Which is on the topic, India's decade, what is in the mind of the market? Please join me in welcoming our next speaker, P. Krishnan, a Managing Director and Chief Investment Officer from Spark Asia Impact Managers Private Limited. A big round of applause for him, please.
Morning, everybody, and thank you, Transformance, for giving us the opportunity to be present here. Thank you all for being present today. The topic I'm presenting to you today is titled India's Decade and what is in the mind of the market. It's a very intense topic, much in discussion, so I will not focus much on the economic theme and the pros and cons of this topic, but we'll try to connect the topic to how the market may look at it as we go forward in this. At the outset, let me just bring to you the chart on India's progress vis-a-vis China. This is an interesting chart. The base year for India is 1991, and that for China is 1982, the respective years in which both countries started their economic reform journey. Both countries were of roughly the same size when this journey started, and by 2007, when China had finished roughly 25 years, and India had finished 16 years, 17 years into its reforms, both economies were similar looking, and the expectation was that India will follow China's path in the next 10 years. And this is something which you have, as a fund manager, have sold in Europe, and there was a lot of expectation. And look at what happened in the next 15 years. Obviously, India has lagged, and the reasons for that, global economy was not of great support to anybody in the last 15 years as it was to China from 2000 onwards. And then there are other structural reasons as well. But I will just conclude this discussion by saying that we are still in the hunt. We are at a point where it is quite possible that the curve lifts up for India, and it will yet be India's decade going forward. That said, what if it is India's decade? What is it that the markets are worried about, both globally and from India? So far, even though India has not done as well as China on the economy front, we've seen the markets diverging. In the last 25 years, Indian market has given about 7-8% compounded annual return, whereas China has given just less than 1%. And there are strong reasons for that. One being that India has been an income-friendly market, stock market and an economy. Market leaders have been able to consolidate their presence. We have considerable impediments to doing business and for competition coming up, but we have been a friction-free stock market for large part. This has flowed through to higher returns in the last 2 to 3 decades. So I'll focus on a few trends that will be in the mind of the markets as we go into this journey in this decade. First is inflation. The previous speaker alluded to this, and the cost of capital and interest rates. They are all connected issues. The picture I'm presenting to you is that something has changed fundamentally, and this is a decadal shift. And you can see that inflation has broken out from a range it was for as long as 4 decades. And in the 1970s, inflation was high, and that was sort of tamed, and I'm referring to the mother market, the US, that was tamed in the early 1980s by Paul Volcker, the then chairman of the Fed, and that actually set off, and consistently low and stable inflation over long periods of time have led to prosperity, economic growth, income growth, and great stock market performance everywhere in the world. You can see as the US CPI has averaged just about 3%, the per capita income growth has averaged more than 4%. This over a 40-year period is very, very significant. Similarly, in China, the low levels of inflation over persistently long periods of time has underpinned China's success as an economy. And this is something which we may not have had, or we may not have seen in large measure at any point in India. You look at the market performance, the period between 1981 and 2007 was probably one of the best periods for equity markets in the last several decades. That snapped in 2008, and then markets have had a very strong comeback. But the comeback that the markets have had post the fall after the global financial crisis have been helped along by very low levels of interest rates, cost of capital going down, maybe for not all the right reasons. Now something has changed, cost of capital has started to go up, and this will have continuing impact on both the economy's growth and inflation, and equity markets over the next several years, and that's what should interest us. The second trend is financial repression. This is again related to persistently high levels of inflation. Government debts around the world have gone up significantly after COVID. You can see what has happened to the US government debt. And history has taught us that it is in the interest of governments to, if inflation remains high and nominal GDP, which is linked to inflation, goes up as a result of that, it is in the interest of governments to keep inflation rather high from this perspective in order that they inflate away the debt. This is something which governments have I think, done throughout history. For instance, India, this has been institutionalized. SLR is nothing but a legally sanctioned measure of financial repression. This has crowded out savings, in which government intervenes compulsorily and takes away the savings. This is inflationary, and inflation in fact aids this. The Indian government debt has also moved up post-COVID significantly, and so has the debt levels in China. Many experts believe that in this environment, inflation will remain a little bit on the higher side for longer. And we'll be referring to multi-year trends over here. So the current year's debate that inflation may have peaked in the US, interest rates may have peaked in the US or are about to peak, have to be seen in context. They may or may not have peaked, but whether they can go back into the big band that was prevailing in the last 40 years, that's highly debatable. It's unlikely they'll drift back to that zone, and that means we have higher cost of capital, and higher cost of capital has an inverse relationship with valuations, which we'll get into. And markets are in the process of discovering it. And we are not yet there in terms of fully recognizing this impact, because there is a hangover from, what was almost like a free lunch in the last 15 years by way of low cost of capital and cheap money. The third trend is deglobalization. This has been, you can see the chart on the left-hand side. After China joined WTO in 2001, the trade boomed. And China was a source of deflation, and therefore also kept inflationary forces in check over much of the last 2 decades. The world globalized very rapidly. It's very evident from the chart over there. And maybe from the time of Mr. Donald Trump, this has been on the decline, and after COVID, it's further going down. But geopolitics has made this heady mix very complicated. You see on the right-hand side the concentration of foundry capacity in Taiwan. And you know that China has been making all sorts of threats on Taiwan, and the implication of any action from China on Taiwan, which, by the way, we believe is highly unlikely. But the fear of any action from China on Taiwan is huge. And practically, all the small things that we use, gadgets that we use, will probably be unavailable if something were to happen to the foundries in Taiwan. And this fear is going to further drive every country, every large country manufacturer, to look at alternate supply chains over, and this can't be done overnight. So of the 3 trends that I mentioned, this is ironically very positive for India. Previous speaker referred to to manufacturing picking up, and China plus 1. This is related to that. This is a huge thematic tailwind for India for the next many years. We are a large market, and we also have the potential to be a large producer in a variety of things. And as deglobalization picks up, India should benefit, because deglobalization doesn't mean, I think, globalization going away fully. It means the supply chain sort of, I think, widening out. So those are the 3 trends which I think are occupying the minds of the market, both globally and in India as we speak. These are longer-term trends and not trends that determine share prices or stock market levels over the next month or quarter. But the overwhelming trend, or the factor that occupies the mind of the market, particularly in India, is valuation. And this needs some explanation, whereas I think there is constant reference that valuations have become more reasonable. I'll in one subsequent chart argue why that's not presenting the whole picture. But even on a headline basis, the Nifty earnings went ballistic after COVID, and it just come back into the level of 1 standard deviation. In the meantime, the India weight in MSCI index, which is a very widely followed global index, has skyrocketed. This is a good development, So on the one hand, you have a lot of money chasing equities. On the other side, we are not at comfortable levels on valuation, and many strategists, observers, analysts are still to come to terms with this. Most of the research and commentary on the subject focuses on incremental data points saying, market has corrected by a certain bit, or stocks have corrected by a certain bit, but the big picture is still very much, I think, very much cautious on valuation. Here is the global picture. This is a very long run data, 50-year data on the US and trailing PE multiples, so there is no bias of forecast in this multiple. And we saw that if you divide the last 50 years into two, the average itself has been lifted up because the last 25 years have been seen valuations creep up. And this has to be linked to the conquest of inflation, as it were, and the drop in cost of capital and interest rates starting the 1980s. Now with that turning north, it's highly debatable whether this curve can really look up. So it's highly debatable and highly questionable whether in the near term, as in next 3 to 5 years, we can get a bull market in equities anywhere in the world, in the US or in India, which will be fueled by valuation re-rating. A lot of what returns we get in equities have to come by genuine earnings growth. And on the right-hand side is a sort of chronicle of various measures in valuations, whereas the top 3 measures have remained kind of evergreen for 100 years. Many other measures have come and at various points have been touted to be the holy grail or something that we are supposed to follow. But most of those measures haven't really lasted for very long periods of time because in some part or the other, there were measures that were brought in to justify prices and not really as consistent measures which we can hold out across cycles. So this is why I believe even as valuations in India at the Nifty level have moderated, as the previous chart showed, that doesn't tell the whole story. The two parts to this, the more expensive part of the Nifty is the curve above, and that has not moderated, or that has not moderated enough because it went up quite a bit, and it has been going up ever since the era of easy money came to be. And whereas it has fallen from the peak, it still hasn't gone anywhere near the pre-existing levels. Whereas the bottom half of the Nifty, I think that's been much more subdued in both its re-rating of valuation and the way it has behaved in the last few years. If you really look at the earnings growth in the last 5 years, that spans COVID, of course, these two classes of stocks, and these are simple numbers taken from published data, the earnings growth is not much different. So yet you have several of these stocks in the top half trading at 60 times, 70 times, 80 times trailing PE. And most of the research on the subject, if you look at analysts and look at their research, they focus on incremental data points such as earnings beats, which are somewhat inconsequential now that you have a trending market that has snapped. When there was a trending market from 2008, 2009, all the way to COVID and beyond, incremental data point mattered. Somebody expected 2% QOQ revenue growth and company delivered 2.5%, that was good enough. Now, take the results of TCS. We don't own the stock as a disclaimer. Nevertheless, the December quarter earnings were supposed to be a beat from the point of view of many analysts. It's 0.5% sequential growth beat. Good company, we are not on that debate. But it's meaningless. You look at the whole year growth, it's coming off from the previous years, and it's at maybe at best at, I think, high single digits or low double digit kind of number. And the valuations have re-rated substantially after COVID. And so this kind of analysis which goes back and forth is not going to be very helpful. And as investors, we may be hugely distracted if we follow that. It may be useful to refer to those notes, but the key argument on stock recommendations may not hold forth. With that, I refer to the Norwegian Pension Fund as the world's largest family office. There's good reason why I refer to them as the world's largest family office. In 1969, Norway found oil in the North Sea, and there's a long history to this. There are other European countries who struck gold in South America 200 years back, which was Spain. They squandered away the wealth, and they are one of the poorest countries today. Norway went on to legislate that this money will be used for posterity, for wealth transfer to future generations, and that's the genesis of this fund. And in the last 25 years, they have been a big force in the global equity market. But the point I wanted to highlight is the statement from the CEO of Norwegian Fund in 2021 December, that a 6% growth which they saw in the previous 2 decades may not repeat in the next several years. And in 2022, we saw minus 14% return for the fund. My last slide, you had 6.6% return for this fund from 1998 to 2021. And if you just take it to one more year, 1998 to 2022, it drops to 5.8%. This is the importance of capital preservation and risk management, which is of particular relevance to the audience here. With that, I'll stop. If there is time for questions, 1 or 2 questions, we can have that. Thank you.
Thank you so much, Mr. Krishnan. Maybe we can take 1 or 2 questions. Any questions? Okay, thank you so much, Mr. Krishnan. We now move on to the next panel that's on the topic of emerging investment themes with family offices for long investing. Please join me in welcoming our moderator, Mr. Sanjay Patni, Associate Director, National Head, Institutional Sales from Mirae Asset Investment Managers. Members accompanying him is Ms. Benaifer, Chief Investment Officer, Ray Amit Patni, Family Office, Mr. Shekhar Jadhav, Director, Property Advisors Private Limited, Srinivas Shishadri, Head Investments, Mirabilis Investment Trust, Ms. Garima Bangar, Lead Private Investment at Chairperson Family Office, Hero Motorcorp, and Mr. P. Krishnan, Managing Director, Chief Investment Officer, Spark Asia Impact Managers Private Limited. A very warm welcome to all of you. Please, a big round of applause for the panel.
All right. Good afternoon, everyone. I'm sure since morning we are seeing multiple sessions, and we started to hear why you are here. Okay, from those reasoning till now, we saw multiple things about markets, about sessions, about how equity markets are doing, and Swaroop did talk about on the part of risk and compliance and strategies. I think all of us believe that markets are here to stay, and that's where you make money about. Let me introduce myself. My name is Sanjay Patni. I head India for institutional business for Mirae Asset. Mirae is a South Korean asset manager and a pure asset manager managing close to $650 billion of assets worldwide and close to present in 50-55 countries now. One thing I can tell you, this is our 15th year running in India, and it's been a phenomenal journey for the organization in India. I think we are close to 1,20,000 crore of assets, and we're 10th largest AMC today, and continue to engage with investors like you and investors like you for sure for so long period of time. Let me go back, because when I read this panel session topic, let me go back a step back and say I always use analogies and to talk about it. Maybe that helps in understanding. I have only one point to say. I'm sure all of us follow cricket, right? All of us follow cricket for so long, being Indians, right? I'm sure all of us seen Sir Don Bradman. We always heard about him. He's been a great guy, fantastic cricketer, the best in the world for so long, true legend of the game. But why am I talking about him? What is more important is his career spanned in the cricket for almost more than 2 decades. 20 years, okay? We always compare, Tendulkar gets compared to him, and many others now, Kohli gets compared to him and all that. But let me tell you a more important thing, which is what the point which I'm trying to derive is his career of 20 years, with a strike rate of almost 99.5, plus scored almost 7,000 runs, 6,996 runs over 20 years. But let me ask you a question, all of you. Do you know how many sixes he has hit in 20 years career? Anybody can answer in the audience to me? I'll leave the question to panelists also. Anybody can answer that? Don't Google it. None. Okay, none. Less than 50. Anyone want to take a guess?
Very few.
Well, there you are. This is where the equity markets are. Now you know the answers. Okay. Okay.
I'll ask you one more question.
He just, huh?
Can I ask you one more question?
Please.
How many grounds did he play on?
22.
And
I'm a salesperson. No, I can answer anything.
His majority of matches he played on 5 grounds.
Yeah. Yeah, sure. So he was primarily against England most of the time, for sure. Let me tell you, in 20 years' time, he hit only 6 sixes. Only 6 sixes in 20 years, being the best batsman in the world ever in cricket, whatever you might say. So not 0 for sure. Okay. The point which I'm trying to derive, this topic tells me a very simple thing. He had the low risk, high breadth, strategic accumulation of run strategy with him. He was steady, he was sticking to his guns, took the stand and continued to hit. The bowlers were scared of him. And he hit the runs when he didn't have safety guards also, if you recall. Those were the days. I'm sure you remember Gavaskar with the skull. I'm only trying to narrate here. All these gentlemen here and the panelists here are going to talk about next 30 minutes. I know I've taken 3 minutes of theirs, but also tell you that once you study, once you remain sticking to your guns, I think that's where long investing comes in. Irrespective what happens during that period of investments, you stick. You actually make money. On that note, let me introduce my panelist here. On my left, maybe Garima. Garima is from Hero Motocorp Family Office, Delhi. I have Banaifa with me from Amit Patni Group, Ray Global from Bombay. We have Srini from Bangalore, from Mirabilis K. Dinesh office. We have Shekhar from Pune, from Probity, and Mr. Krishnan from Chennai. So you can see all different cities in India, well diversified, and I'm sure they're going to accumulate various runs in this next 30-minute session. I can assure you that. On that note, let me come to you, because ultimately you guys are the stalwarts of making those and those. Let me jump to anyone. If you maybe let me jump to Srini. Srini, you have seen over a period of time the treasuries have evolved. You have seen over last many years now, maybe more than 10, 15 years now. What do you think is the next big thing treasuries have seen in this period?
Yeah, thanks Sanjay for the invitation here. Glad to be here among all of you. So I think 10 years is a long time. If we say the starting point is say somewhere after the taper tantrum, which was one of the bigger events from a financial market standpoint, things were quite glacial for at least 3-4 years after that. And we've seen, of course, a credit shock event back in starting the kind of tremor started in about 2016 and then finally hit in 2018. And then, of course, the large equity market drawdown during COVID and the subsequent recovery. So, I mean, 2-3 things to learn here. One is that equity investing or say asset class decisions cannot be very plain vanilla now. Yeah. We are living in a lot more volatile world. What we have to do is that we have to move away from a very simple asset allocation model framework to a risk pool framework, whereby you define as to what is the duration risk you want to take, what is the volatility or permanent loss risk that you want to take in the investments, and then carve out separate pools of allocation and start investing in those buckets. So that is point number one. The second development has been the heterogeneity of asset classes themselves, which have come up in the last 3-4 years. So I think when we started about 6-7 years, it was primarily a decision between public market and fixed income, a bit of VCP. Now I think a lot of alternative asset classes have emerged. We ourselves have moved to a multi-asset class investment model where we specifically identify pools of alternate asset classes, and within that also 3 or 4 different sub-pools of them, so that we do it. So I think these are the 2-3 things in which life has changed for us. The other final point is that I think risk management also needs to be more dynamic.
So whether you are investing in an equity portfolio or a fixed income portfolio, it'd be sensible to understand what are the underlying constituents of investments which are there, and then what kind of risk reside in these. And it definitely helps anybody to evolve as an investor to spend some time doing that. So I think these are the 3-4 top of the mind things which come to me.
Sure. So continuing that, Shekhar, maybe I'm sure in a managing portfolio, especially long investing, there must be some metrics in your mind that these are parameters of profitability or a revenue or something, what I look at. What are that in your mind?
At company level?
At company level, investment level, as a portfolio level, for example. Maybe selection of portfolio, I guess.
Yeah, so see, at portfolio level, most of the people don't, and I was chatting with Mr. Krishnan today morning, risk-adjusted return is something which, a lot of people don't understand and a lot of people don't pay attention to. Unfortunately, today, all of us know that GSEC 10-year is, giving us anywhere between 740, 750. So that 1 unit of extra risk is giving you how much return, and is it worth taking that risk is something which many people don't pay attention to. So I think that is one specific thing, at a larger portfolio level. Sure. And of course, when you do allocations between debt, equity, of course you have to pay attention to how much alpha you intend to make on these respective allocations. Liquidity is one more aspect where you need to be careful, especially when you invest into PEVC kind of investments, or within public listed equities where the depth is not that great. You need to be very mindful of how much more capital you can put into that one specific stock or a specific sector. With respect to companies, of course, there are multiple parameters, but I feel capital efficiency is very critical to look at. And capital efficiency is very different at different stages of life cycle of the company. At very early stages, the capital efficiency is very critical for either building the product or acquiring the customers. And as the company grows, the capital efficiency needs to come into in terms of the ROE, ROC, and the reinvestment that you're looking at. So these are the broad, at different levels, what you would look for.
Sure. So Banaifer, if I were to move to you, I mean, what Shekhar also said, and the treasury side, Srini talked about, which sectors do you like the most? I mean, I'm sure the plethora, which I'm sure we are hearing since morning, but what is that you like and for family office to go along?
Thanks, Sanjay. So I'll just give you a little brief of what we've been doing. We've been at this for more than a decade now. I was just telling Sanjay in one of our chats. We started with the public markets naturally, in varied sides, equity, public markets, and fixed income, etc. And slowly build on a private portfolio as well, which ranges from early stage company to mid-market companies, etc. And we have about 15 of them now. So we have a mixed range of what goes on in the public and private markets. And surprisingly, you will be shocked to know that there is a lot of correlation between all these put together, because the flows in the private markets are subject to what's happening at the macro level, to what's happening in the public markets, in debt and in equity. And I've been fortunate to see both sides of the world up close. Coming to what looks good, or in the public market side, I think today's market is very, very tricky to take a stand on, and we are waiting for the situation to evolve. But having said that, in the public markets, we are constructive on banks. We've had those positions for the last at least a year plus in some contexts. And on a little bit of the alternate side, we've been very constructive on silver. So these are two things that we've had. I mean, banks is very unanimous. I think most portfolios would have it. Historically, we had also played autos, which worked out well. So that's on the public market side. On the private side, it's very individualistic to which family is running what mandate and how it works. So for us, we did not want to build a very large team on the private market side. And we actually went about doing only 3 themes over these last 12 years. We started with consumer. We went on to take on fintech and financial services because that's something that we understand very easily. And the last part we added was, which Sanjay told me, I did not know this word, how does this work, is content.
Yeah.
So basically when Mr. Ambani came on screen and said that I'm going to give 1,500 rupees these mobile phones across to the next generation, we said it's content going forward. So that's what we've been doing, and hopefully we'll succeed at it.
I'm sure there's no reason why not. I'm sure you're a breadman as well. Let me bring Garima in the conversation. Garima, you represent a house of vehicles, if I can use the word, maybe world's largest one, who are visionary. Where are you seeing electric mobility moving? Because that's a buzzword, and I'm sure 50% of the people must be aspiring to own, if not they own right now. What is your, anything what audience should know about?
So very thoughtful of you to say that, calling us a house of vehicles. So as a family office, we keep a very close tab on the entire EV ecosystem, and we see that going forward in the next 3 to 5 years, the entire stock of the vehicles that we see on road is going to change, and it's definitely going to be EVs for sure. And it's because of the government push and the incentives that are there, the rising prices of the fuels, and of course the awareness around the climate change. So we feel that the entire stock is going to change, and from the family office perspective, we keep a close tab on the entire EV ecosystem, be it battery swapping, EVs, and the component manufacturers. So that is something that we really like to do. Another thing that is actually playing out well in the recent is the D2C ventures that are coming up really well. That's because obviously the disposable income of the consumers have increased, plus the digitization has made it really possible for the upcoming companies to become brands, and the digital marketing has played a really good role in making the consumers aware about the brands. So I think these two themes we are currently playing on, and we believe that over the next 5 years this is going to be really good for the overall portfolio. So that's from my side.
Sure. I would say not 5, maybe more, I guess, a little longer to you for sure. Mr. Krishnan, if I were to move to you, I'm sure she talked about content, she talked about EV. Let me ask you a question. Economic uncertainty, I saw your presentation as well on the markets. Geopolitical uncertainty, even bigger. I'm sure I like the word called disruption. What do you see in the disruption today?
Yeah, so a lot of the global trends that I alluded to in the presentation are anti-themes rather than themes. They have a certain amount of negative connotation when it comes to the outlook for equity markets and equity investors. But like Sanjay mentioned, in anything that causes a lot of disruption, there may be opportunity. So obviously the previous speaker in the morning referred to China +1. It's a much talked about theme, and it's playing out in some ways. I think the industrial companies who we've been speaking to increasingly mention that compared to the pre-COVID days, if they today increase prices, there is more acceptance from customers. In the pre-COVID days, maybe they just quietly went and bought from China. Now they are willing to accept a bit of price being passed on, obviously because of the geopolitical situation and supply chain related concerns. Now this is clearly going to gather pace, and what is important for portfolio managers is to kind of, I think, look at this and see whether this can be played over a 2, 3, 4 year period. Usually in our process, we look at 2, 3, 4, 5 year trends, but I'm a very firm believer that 4 to 5 year financial forecasts don't make much of a sense in today's world. Has never made a lot of sense in the last many years. So you tend to then break it down to 2 year financial forecast. Yeah. And then you have to be, I repeat, very careful about what you pay. And that is the biggest challenge in India. I must say that most of the things we look at just don't stack up. So, I really sort of, I think, think that the job of very big money managers is extremely complex today if they have to do justice to their job.
That too with the regulatory environment, I believe
Yeah.
so. Okay, sure. In the mid of 22, Srini, if I were to go back to you, I'm sure last year, mid of 22, we say storm. Okay, we made a lot of money before that. It was a value market. People made money. Now that storm is away, or are you still in the camp that no, storm is continuing?
I think there's no straightforward answer, but basically, say, the way I look at it is that asset prices or valuations and prospective returns are two sides of the same coin. So when say asset prices deflate like they did last year, it makes valuations more palatable and hence prospective returns improve. So for example, I think we've talked about fixed income earlier in the day as well in one of the sessions. So last couple of years when they gave fantastic returns just after COVID because everybody had a risk-off kind of approach to investing, that asset class delivered very well. Over the last year and a half, there's a very painful ratcheting of interest rates by central bankers globally. So this asset class has suffered for it. But now prospectively, it looks much better, right? Okay. So I believe a similar process is working through in the public markets, but not fully yet. I think we are halfway there probably when we started this year, and then now we also see last couple of months being a bit more painful. So I believe that will also work through this year, and then the asset class will again come back to the attractiveness. On the private side, I think new money is being raised at sensible valuations. But wherever valuations are very high for some of those growth stage companies, there is still holding back on whether to kind of come down on the valuation and start raising fresh capital. So I think that is still a bit, say, one step behind the public markets in terms of working it through. But this year, definitely from a starting point perspective, you have more options to invest and make returns against the risk-free part of the fixed income market. Looks great to start with, and that should be a starting point for you to evaluate prospective returns in every asset class and take decisions. That's how I look at it.
So you are saying risk-adjusted return like Shekhar talked about. Exactly. I'm sure you're in the same camp as well. Benaifer, if I were to move to you, I'm sure emerging opportunities beyond vanilla, I'm sure you talk about maybe basis the portfolio management, with AIFs, anything which you like, which is something exceptional which you feel you've used and maybe you like the strategies.
So I was a part of a PMS team when the word PMS was not known.
Yeah.
Okay. And when I got a call for that interview, I still remember, I said, what is this word? The only one I know is related to women. So, coming back from there, that was about 2004 or so, 5. From there, this word has actually got its credibility in the last 3 years. And that's quite heartening because what we were trying to do back then is actually fructifying now.
Yeah.
So this whole bit of AIF category 1, 2, 3 has opened up a whole new universe for us as investors. I'm sure all of people on the panelists feel the same. But it's also that much more tricky because there is no classification. Just like in mutual funds now, you have a very clear categorization. What is large cap? What is mid cap? What is multi cap? I think that categorization is completely missing in the AIF piece. So every fund has to be viewed in the light of dissected into the asset class, the risk return, the adjusted risk to be played on it, and then determine whether there is a suitability for it, right? So that's just the overarching piece of it. To answer what Sanjay asked, so there are credit opportunity funds which exist, there are venture debt funds which exist, there are infra yield funds which exist. So even road assets, etc., have started getting monetized. And as a ultra high net worth, my family office can use investments into this space. And these are more, and as we speak, it's evolving by the day. So every day I see a newer version of what can be done in the AIF side. Yeah. But I think this space also is going through regulatory changes. There is a lot of streamlining happening. But it's encouraging because you see a lot of entrepreneurial spirit and fund managers taking up different genres, which is way back. I remember again to go back to that PMS time. We were trying to float a gold-linked debenture at that time. And you would not believe that all we managed to gather, and I used to be part of a very large house at that time, all we managed to gather at that time was a meager 20 crores, okay? And today, the whole, and this came only from about 3 sophisticated investors, because PMS used to have a 5 crore ticket, if you remember at that time. And that's how this world has evolved. And today, gold link, loans, etc., you see ads all the time of securitization happening. It's encouraging, but lots of things happening.
Sure, for sure. AIFs, alternate markets have grown to almost 6.5, 7 lakh crores, so I'm not surprised at all. Shekhar, let me put you in a spot. Okay, let me ask you an odd question out. Which sector you are odd man out to not consider? Let 4 of them consider, but you'll say, no, I'll not consider it.
A specific sector?
Any sector.
So I feel, honestly, banks have already run up over last couple of years, and there will be credit growth for sure. And we also did participate in that segment, and of course made a lot of money. But I feel, again going back to the risk-adjusted returns metrics, the amount of risk that you take and the valuations already peaking out in some of the banks for sure. I think that one segment I feel we should be very, very careful about. Okay. And select names, of course, will definitely perform well. But on a whole, I don't think it will pan out as because it has become consensus now, and consensus most of the times don't work. So that's what I feel.
So you don't like 37% market, basically, of Nifty. Okay, sure. let me accept to that for sure. Garima, let me ask you a question. Any sectoral themes which you feel are maybe genuine from your family office perspective and maybe worth considering, looking at scale and maybe a sizable opportunity?
We have been looking at the offshore space for quite some time, and having watched the equity valuations where they are currently, we believe that the long only funds could really play out in the future, specifically in the autonomous vehicles and electric vehicles and associated technologies. So it could be like component manufacturing and also the technologies which are related to EVs. So that is something that we really look up to. Also, alternates is something that we want to look at, because obviously that provides risk-adjusted return, and the absolute return funds and long-short fund strategies, the strategies really play out well for us. So these are the themes that we want to look at for the offshore allocation. So obviously there are a lot of ETFs and funds which are doing this. So happy to look at all of those. So that's it.
Sure. Mr. Krishnan, I mean, just to continuing the conversation there, you have been managing funds for so long and you've been in the markets. How do you build that, portfolio, the life cycle of that portfolio? What are the characteristics you should look at it?
Yeah, thanks for that question, Sanjay. So let me start with this assertion that a good analyst may not be a good stock picker.
Sure.
A good stock picker may not end up being a good portfolio manager.
Sure.
So though these are, these can be, I think, taken as one continuum, doesn't work out that way. So to illustrate this a bit, the number of us and a lot of fund managers and laymen, they say, I bought HDFC Bank in 2001. And then 20 years, it's become whatever X.
Right.
But has your portfolio become that much X? We can ask a fund manager, individual investor, whoever.
Sure.
So, and one more distinction is that a professional fund manager has certain boundaries. So, when you operate on your own money, which family offices do in part, and then they engage professional fund managers, the boundaries tend to be different.
Yeah.
A professional fund manager, for instance, I'm usually amazed when fund managers say, over the next 10 years, I like this.
Sure.
Because over the next 10 years, they may not be in that job. Over the next 10 years, people are not entrusting money to them.
Sure.
So with these sort of constraints or considerations in mind.
Yeah.
When we construct portfolios, we have to look at the interplay of risks that happen between stocks.
Sure.
And at the end of the portfolio construction exercise, do you have a good handle on whether there is consistency between what you thought you wanted to achieve and what is out there on day one? For instance, to illustrate this, if I say I'm very wary of global growth and end up having, let's say, a lot of IT services, right?
Yeah.
What am I trying to do versus what I thought or articulated? Now, it's a different matter that a lot of people in our industry articulate something and do something else.
Sure.
So that I'm not going there.
Sure.
But if you really have articulated something you believed in and you want to implement it, which is a fair thing to do,
Right.
then this construction should reflect that articulation, and you should have an understanding of the risks, therefore, you are taking in the portfolio, having constructed it in the first place. Then there is the issue of monitoring, because you mentioned the life cycle. So the biggest mistake that I think this, of course, I have learned it over many long years of making mistakes. The biggest mistake is to not recognize one. And people often ask, what is my stop loss? And and usually stop loss is supposed to be a number, right? 10%, 5%.
Yeah.
For me, the stop loss may be a number. Of course, numbers are important. But a stop loss is also a deviation from, a significant deviation from what I assumed or what I thought would play out against what is playing out.
Sure.
And that's a very strict stop loss. One example I can give is that we had this exposure in one refining company, because we thought there was value and it made money for us in 2021-22.
Sure.
And then the Ukrainian war broke out. We exited that stock within probably days of the Ukrainian war breaking out, because it was clear to me that that was not in the picture.
Sure.
Nobody had that in the picture. So we can go on and on about it, but I hope I have just sort of encapsulated the thoughts on this.
Sure. No, completely agree with you. Srini, what are the real big opportunities do you think, and maybe sectors, anything specifically what you're looking at? What's interesting?
Yeah, maybe we've already had some discussion on the public market side, so I'll probably talk about something else here. So on the alternate side, there are two asset classes that we have been kind of allocating reasonably well. One is the question you asked about the real opportunities. So there are real assets, like for example, the infrastructure assets or say commercial buildings, etc. And then these get converted once they're completed, they turn into yielding assets.
Right.
So we believe this is a space where all investors should kind of, from an allocation perspective, spend enough time and understand how opportunities lie. Of course, you have to examine risks like the quality of the asset itself, who's the counterparty, who's paying you money, etc. But these could be offering you reasonably good risk-adjusted returns. That is one. The other part is that, again, venture capital and all we've already done, but the other piece which is opening up is the venture debt. So there we believe, again, you can look at investment managers who had at least 8 to 10 years kind of experience doing investments and look at their track records in terms of how their credit decisions and panned out. And then basis of that, you can take kind of some exposures if that seems to fit some part of your portfolios. I mean, these are the two things I would highlight. Yeah.
Oh, interesting to know, because that's one space which I've been talking to a lot of family offices and they have been really sticking to it. There is no doubt about it. Shekhar, let me ask you, I'm sure I had a long chats with you offline as well. Does fixed income at this level exciting for long investing, if I were to say?
Yes, the short answer is yes. And so we've been allocating to fixed income, especially on the long duration, since last 6 odd months. And so, we kept our mod duration on the overall portfolio fairly low coming into, when the interest rates were going down to 2020-21. And so that really helped us because, the mod duration was very low. So, it did not impact too much on the yields overall. And as interest rates started going up, the mod duration was low. So, effectively we were, accruing a lot of income on that. But now I feel we are probably at the, fag end of the interest rate cycle. We probably one more hike or a couple of more hikes in India and the US. And we've been laddering over last 6 months across multiple buckets, keeping in mind the liquidity requirements and the kind of carry that we are getting. So right now, yes, we keep adding into the 6-year, 5-year bucket, and also the 10-year bucket. In the past, we've allocated to the 20-year bucket. So yes, it's in my opinion a great time to add to fixed income, especially long duration if you are very low on the mod duration side.
Sure. Benaifer, I mean, this question I always ask, and many investors have always asking and understanding, liquidity management is important, whether short term, long term, what you're managing, etc. But there's always a challenge between balancing survival, growth we saw in last maybe 3 years, etc. Even before we getting into COVID, economies were in a bad state anyway. So where are you seeing and what kind of phenomena are you seeing and opportunities do you see there?
So on the liquidity management front, I think because our, our promoters have been encashed out of the business and we really don't have an operating business which requires continuous cash flow management. I think we are a bit lucky because we can have investment as a thesis and go across with that. The smaller requirements or maybe if there is a major event in the family, etc., those are pre-known and that can be pre-planned. So there is nothing sporadic. So we actually don't do much of short-term or just 2-month, 3-month kind of things. We are not, I feel money lying outside in that bucket is really a waste for an investment return kind of perspective.
Understand, yeah.
So we are investors and we stay that way. In the context of what was looking good at COVID and post-COVID, see, COVID actually was a great time for shopping, to be honest. Yep. And just leaving the health concerns aside, we were pretty agile to kind of see where we saw the opportunities. So of course the first part of it was that on the private side, we had kept reasonable amounts to bridge our companies because that was the first thing which was required. Most of them would not be able to anticipate the cash flows and we didn't want them to run out. So that was first. The second thing was I still remember it was 2 months down the lockdown and we started heavily doing things on the equity side because we kind of felt that it was at great valuations at that time and we topped up at least the ones where we saw opportunity on the PMS side, we topped up there. So those were things that we did. We also saw a good amount of, like Srini mentioned, valuations became a little more reasonable, a little more, I mean, though I did meet some companies which were still gastronomically at 10x and I said, okay, we'll see you in the next world. But, we did get some companies who were more realistic, who understood what they wanted to raise and their sustenance was more important than things. And we did deploy some monies into those fees as well.
Sure. So Garima, I mean, to ask you the question, because this is something which I have not asked till now, maybe overseas investment opportunity, does that chord strike your family office? Anything, any sector worldwide which you feel, other than EV, if I were to ask you that? So that's, I'm sure, your favorite one.
Obviously quite important to us.
Yeah.
But the other themes that we want to look at is definitely, sustainability, climate tech, and obviously the green energy, so to say. These are going to be the upcoming sectors for sure. Also, in terms of the kind of asset classes that we want to allocate is basically the fixed income, I would say bonds or other opportunities, fixed income funds that other panelists have also talked about. So, we are looking at the longer tenure or longer duration funds. And because, there are two sides to it. Either you hold them till the end and obviously and cash the YTMs and, just realize the YTMs. Or maybe, just, if you want to, realize them in between. So once there is a interest rate reversal happening, so you are bound to gain from the MTM gains. So that is something that we want to look at. and fixed income opportunities, as well as the other themes that we want to play out is climate tech, digital greens, and things like those. So digital economy, so to say, digital economy and digitization. Although India is ahead of the curve, but for the other countries, I think it's still to happen, and it is bound to happen for sure.
Ahead of the curve without listed companies in space. Fair point. So that we agree with you for sure. Mr. Krishnan, you have seen a long journey in equity markets. This is one thing which I'm sure will excite everyone to understand. And I see some of the partners here, data, technology, the speed of data, if I were to say, how is that changed in helping you in taking decisions now? Because portfolio management with equity T+1 now, I'm sure it is even further challenged.
I'm not sure whether it's helping us because it's causing a lot of issues. There is a surfeit of information, and handling emails, even for somebody of our size, is a challenge. So when it comes to technology, the first point that should be noted is technology is a tool and not a solution. So in the pre-technology days, as it were, we had tools which still managed to keep track of data. You know, I remember we had a database of 600 or 700 files. Somebody used to cut newspaper clippings, paste it. I've known investors in those days who bought one share of each company so that they can get an annual report and put it in the file. So this became, that was the technology of those days.
Correct.
And it sounds very primitive, which it was. That was what was available, and we've moved on. And now you can't obviously operate on that model, and you need not. So to put it in plain speak, I think Excel was the biggest technology tool that happened to this industry, and nothing much has happened after that so far. Now, Excel was a big leap. And I think, post that, I don't know whether it has been, technology has not given us sort of, I think, such huge productivity improvement. Of course, I think tools that are coming in. On the topic which I see being talked about, whether technology can sort of take over the fund management role and, ChatGPT and whatnot, I think, at least in the Indian market, we are very far away. This is, if this were not mispriced, then we'll be out of a job. Most of the time, this is mispriced.
Correct.
And such mispricing is due to not just fundamentals or information availability, which today is more or less democratic, but because of the huge sentiment swing in the marketplace. And I don't know whether technology can map that in a big way. So to answer your question directly, I think since Excel, I haven't seen massive improvements in technology, sort of, I think, helping investments. I'm sure people are using. I remember we used a tool which helped us. For instance, if you give a keyword which will kind of ferret out all kinds of data, but that particular venture somehow, I think, didn't do all that well. So people are still figuring out various ways to cut through the huge overload of information we are faced with. I'm sure there will be a breakthrough in the coming years.
I remember Harmanpreet Kaur getting out like that, the last second. Okay, when the bet got stuck at the last minute, I agree to that for sure. So let me ask you one word answer, okay? Let me put you in a spot and asking you, Garima, one word answer. Which one sector you are averse to? Quick one word answer.
Real estate.
Okay, Banaifer.
I think real estate.
Real estate. Commercial, residential. Wholesome. Okay. Yashini.
Cyclicals.
Cyclicals. Okay. You remain stickier to BFSI? Infra. Okay. Okay.
Yeah, at this point, IT services.
Services.
Yeah, IT services at this point. But this, let me qualify it, this can change any time.
So which one sector which you are 500% confident about? Now you are going diplomatic as a fund manager.
It's not diplomatic at all. I'm saying that I don't believe that we need to have a permanent view on these things.
Sure.
If you ask me a topic...
Prevailing, current conditions, yeah.
Current question was
which one sector you are averse to completely?
IT services.
IT, fair. Which one sector you are 500% confident about?
Banking.
Banking, okay. Shekhar, now you answer. this question. Which one sector you are 500% confident about? And
fixed income.
Fixed income, 500% confident. Srini?
And the equity, I think, relative preferences for consumer sectors now.
Consumers, okay. Benaifer?
I think fintech in India.
Ah, okay. Don't tell EV, tell anything else.
Yeah, sure. It would be consumer discretionary and I would say machining, automation and machining, manufacturing.
Sure. I can only tell you one thing for sure, okay? I'm sure all, sorry, tell me, please.
So the answer was with reference to the stock market,
yeah,
where it is and not on the outlook for the sector.
Fair point. That's fair point. The disclaimer always part of BFSI sector. Okay, ask me. Okay, so my only question is, I'm sure all of us are habitual of watching 2020. All of us are habitual of, we can watch WPL, Women Premier League also now, but I can also tell you I have some test players here sitting. Okay, end of the day, stalwarts of cricket always came from test cricket, who had the ability to duck the bad ball, to leave the bad deliveries, and to wait for the bad deliveries to hit, and you wait for opportunities to get kicked about. So that's important. You have to be patient and perseverant to have long investing. So let me allow and ask you to have a round of applause for the panelists for being the test players of long investing. Thank you so much, all of you panelists, for sharing your views with the audience. Thank you so much, everyone, for listening patiently. Thank you so much. Thank you.
Thank you so much, Sanjay, and the panelists for that fantastic insights. Sanjay, if I could request you to felicitate our panelists. Ms. Benaifer. Mr. Shekhar Yadav. Mr. Srinivas. Ms. Garima. And Mr. Krishna. Yes. Great. Thank you, all the panelists once again. Big round of applause for the panel, please. So great, it's been a fantastic and a very insightful first half. So we now break for lunch. Good afternoon. So okay, great. Good to know. So I think the discussions have been quite interesting in the first half. We do have more interesting topics and panel discussions coming up. Yeah. So the next Fireside Chat is on the market outlooks and trends, discussion on economic scenario. Very interesting panel session. Please join me in welcoming our moderator, Ms. Parul Shah, Head Investments, HCC Limited. Members accompanying her on the panel is Mr. Rajiv Newar, Group CFO, R.K. Swami Hansa Group, Mr. Ajit Banerjee, Chief Investment Officer, Shriram Life Insurance, Mr. Sachin Jain, Head of Family Office, Inspire Enterprise, and Mr. Amit Agrawal, CFO, Aeon. Big round of applause for the panel, please.
Thank you, Will. And of course, I can fully understand how difficult it is after lunch. So we have kept the most hot topic after lunch to keep you all awake. And here on the dais, you have the best of the CIOs, CFOs, and great lot of experience sitting here who can talk endlessly, but we are going to try to complete within the stipulated time. So here we need to understand through this panel that what happens, what are these market trends, the economic outlook, so many buzz things happening since the beginning of this year, the trend which we set and through the geopolitical risks which arise exactly a year back, sitting here looking retrospectively how things turn out and how things would turn out in future, which no one can guess. That is the biggest bet what everyone here will try to figure out for you, and hopefully it will be interesting. Nevertheless, the GDP and the latest inflation numbers, the dollar rupee, everything is moving in a tandem where what to catch, the interest rates, yeah? We still expect 2 more cycles. The family office, how it is being impacted, some understanding on what happens to the portfolio with the given flow in the trends and the economic factors. Does it impact Does it not? Or do we change the course of your portfolio investing pattern, etc.? So I would now start flowing out with each of our panel speakers some kind of insights in economic outlook, what we foresee. And of course, whatever we share here is within all the disclaimers. So to begin with, Ajit, I would like you to address that. What do you believe is the upcoming cycle, both addressing the inflation, interest rates, the GDP, the entire outlook, what you may envisage?
So good afternoon, Parul. Thanks for the question, and good afternoon to all. So I think we are at a very interesting juncture in the sense that on the one hand, there is a trade-off now which has to be done, whether we stick to taming the inflation or, we try to, go full throttle on actually, going with the GDP growth. Even our budget also this year, we have seen the emphasis has been to actually, push more towards GDP growth, which is backed by capex, and so essentially that's the trade-off. At the same time, I think we all are mindful of the fact that next year is a election year. So, and naturally, in a democracy, the government, whenever the policy decisions happen, nothing can be decided without, the political, I would say, impact of whatever is the decision being taken in Parliament. So that's the critical, juncture at which I think we all are, the entire country is, and even for that matter, the world also. We have seen that globally, at one point of time, inflation was considered to be a transitory in nature, and as a result of which, most of the central banks thought that, they can possibly, this will go on its own. And thereafter, one after other crisis, geopolitical crisis and all came up. But then, I think in fact of being so strict on raising the rates, which we have very rarely seen, I think 250 basis point rate hikes over a matter of 9 months was unheard of in US. Earlier, such thing happened over 18 months, if I'm not wrong. So that speaks of the fact that how serious, the central banks across the world, and of course led by Fed is. And certainly, RBI cannot, it was also late in the game. And thereafter now, we have also heard governor saying that, we have to balance it out. At the same time, we cannot rock the boat when the shore is visible. That was in one of the statements he made. So naturally, which means that he is trying to find the best mix possible, which certainly is not an easy task. That's the part one of that point what you raised. Second is, as far as the rates are concerned, it looks like, we are nearing the peak, because beyond a point, I think if we go hiking it again, that will impact the growth, which is visible now. Quarter on quarter, the growths are getting reduced. So naturally, one has to be mindful of that. At the same time, the rates what are getting enhanced, that is impacting the short term of the curve quite heavily. So possibly what my reading of the situation is that, there can be, I think, another 2 hikes which may happen as far as India is concerned. And US, anybody can put the guess. Today I was reading an article which says that it might go as high as 5.4. So, of course, there has to be, there has always been an interest rate differential which has been maintained all across. But the bigger thing what we need to see is that earlier when we have seen in US there were steep hikes, there was an equally steep cuts also, rate cuts which has happened. Whether the same thing again will happen this time, and to what extent, India will also mimic that, is what we have to see.
Yeah, so we were just discussing there informally that rate hikes are one, but rate cuts have become more heavily. That has been the past. Only thing what we have not seen was the inflation hiking. India always, of course, we had inflation, but the global trend on inflation is something very first time is being witnessed. So Amit, what about your thoughts on how this trend is going to be, especially the mega trend, and how does it impact the Indian economy?
Okay. So if we talk about Indian economy, and we all know how it
recently surpassed and became third largest economy in the world. And if one tries to gaze the crystal ball of 2030, you'll find that very soon India will topple Germany and Japan and become the fifth largest recently, and very soon it will become the third largest economy in the world. Now, what is driving this frenzy? I would say there are few factors which is driving this frenzy. One is that demographic dividend, which is playing a lot of role in the consumers and markets. Second is, first let me talk about demographic dividend. Basically, if you see Japan's, the older age population is growing, and they are, their economy is expected to slow down. At the same time, second one, when we talk about interest rate and inflation, and Mr. Ajit talked about inflation and inflationary pressure and driving push to the interest rate, rising interest rate, and the economy slowing down. Consequently, I would like to point out one very interesting fact which Mr. Nageshwaran talked about yesterday, our chief economic advisor. He said interest rate are driving up not only because of inflation, but also because of the demand and supply gap in the country. You see the credit gap the country is facing today. Private sector credit is up to 55% of the GDP. But when you look at the comparing countries and some advanced economies, you will see 150 to 200% of the GDP, that private credit. So one is that how do we fill that gap? Probably the interest rate surge is also because of the demand and supply gap, and it will not necessarily mean a degrowth in the economy. And that is why we talk about 2027, top three and other things. We talk about $7 trillion economy. What is next? So I see, and one more thing very important he talked about is what we are seeing is not a K-shaped recovery. We talk a lot about K-shaped recovery. Okay, some sectors are rising very high, some sectors are degrowing. It is not the case. It's just the difference between some sectors rising very fast and some sectors rising slow. But everything is growing, and that is where almost all analysts in the world, every forum is telling that India will be the fastest growing large economy in the world. So what is next? What are the challenges that India is today facing? I think the only roadblocks that India is facing, one is the job creation. It is marred by all the reforms that are getting delayed. Actually, one is the agriculture sector reform. It is getting delayed. Second is, so India is facing all these problems, and I think how do we overcome these challenges? One is the insurance sector. If you see, insurance sector, again, the penetration is very low, and we are growing at 15-20% on annual basis. So I think all these factors are driving this frenzy, and we should soon see India in the league where, and inflation and interest rate will continue to be, interest rate differential will continue to drive the rupee weakening, but I think that will not impact the growth. That's my feeling.
Thank you so much. Now coming to 3 or 4, what you saw here, we are trying to find out that how does the interest rate impact on certain investment outlooks. So let me just address that through the point here is, in fixed income or in the so-called debt outlook, what do you believe that this all trends will result?
So obviously, one thing is we have seen that interest rate hikes and a lot of launch of new debt products in the mutual fund industry. They have happening simultaneously. So in the last 1.5 years, a lot of mutual fund companies have came up with Bharat bond-like products, like similar those products which are investing in government securities and SDLs. And because of the indexation benefit and the taxation benefit that mutual funds enjoy, they are giving you a yield of around 7.5%, which is significantly higher than an FD of any top 4 private bank or even for a PSU bank. So a lot of money is shifting from your typical savings banks account and your FDs to all this, GSECs and SDL funds, because here you will be locking in a good yield of 7.5%, along with, and for a larger tenure. If you look at all the funds that have been launched, they are all 2033 maturity or 2035 maturity. So that shift has been seen in a lot of family offices. Second thing, obviously one drawback in the budget was, not a drawback, but a significant change that the finance minister brought was of converting that MLD, which was treated as an equity product, and now it will be treated as a debt product. So again, a lot of family offices had a large investment in MLDs. So the family offices that I had worked for previously had a significant chunk of debt portfolio in MLDs. And now obviously no one is going to invest in MLDs because that is as good as a NCD, because it will be taxed as a debt product, and so it will be taxed at the highest tax bracket. So reduction in MLD is one pattern. Increase in debt mutual funds would be another trend that I'm seeing in the family offices. And if you have, in last 2-3 days, a lot of NBFCs and a lot of wealth management firms have gone to the finance ministry asking them to, not have the MLD taxed, the ones which are already launched. I mean, you can tax them as debt product. The new launches can be taxed as debt products, but the ones which are already launched and we have already sold to all the HNIs, don't tax them at 30%, please tax them at 10%. So we have to wait for what the finance ministry would say on that. But yeah, and one of the most important change that is going to happen in the Indian bond market, and because of all the factors that they have mentioned, demographic demand, GDP growth, BJP government coming into picture, is the inclusion of India in the MSCI bond index. Now, if that gets included, a lot of foreign money will flow into the Indian debt market, which will be a really good, sign for the, for the penetration of debt market in India. So yeah, these are the few changes that I see.
Thank you, Sachin. Thank you, Sachin, for highlighting certain things, especially on the product outlook basis. Moving back to where we are concentrating today is the macro outlook. And how does this macro outlook channelize and impact the portfolios at various level junctures? We take this round beginning with Mr. Rajiv. Thank you so much.
Thank you, Parul. And by the way, we are not seated as per those pictures. And the photo you see behind is a recent one, not very old one. And I hope to be like that very soon. Okay, good afternoon. Talking about the macro situation, if you, like all of us read newspapers, and the headline news was all about the GDP, right? See, Q3 GDP has fallen to 4.4% or 4.2%, and GVA has fallen to 4.6%, and so on and so forth. And I always believe that, those who live by ratios, die by ratios. But what is very important is to see behind those ratios. And I'm going to just help you peel some of these numbers and just to help you understand or share my perspective. If I was to look at the GDP, 55 to 60% of the GDP is primarily driven by personal consumption. About 10% is driven by government consumption. And about 30% is driven by asset creation. If you look at the three segments over the recent times, the personal consumption has grown marginally by about 2.2% thereabouts. So it's been low. If I was to look at government consumption, which accounts for almost 10% of the GDP, it declined. That's because probably they were trying to manage the fiscal deficit. And I think they've done a good job managing the fiscal deficit. Just to give you a statistics here, 18 trillion was a fiscal deficit that was targeted, but till January, it's only 68%, only 12 trillion. And we don't expect in the next 2 months, it will be 6 trillion. So clearly, the fiscal deficit is under control, but I will leave that 10% aside, which is the government consumption. Coming to the asset creation, I think we are doing well there. my understanding. And there is momentum, and there is sustained momentum. Even if you look at the budget, there is the commitments that we see as far as the asset creation is concerned, capex and infrastructure is concerned, it's been very positive. So if you look at all the three parameters, and obviously the fourth parameter is obviously the net exports, which is negative, but in the recent times, it has improved. So if I was to really look at the private consumption, which contributes to almost 55 to 60%, that's grown by a very small margin. So hold on to that thought, I'll come back to that again. Now let's talk about the GVA. The silver lining is all the segments in, this is from the supply side, all the segments have shown very positive growth. Some as much as 8 and 8.5%. So from a GVA perspective, I think the outlook is very good, with the only exception of manufacturing, which is declined by about 1.1%. Now, if you were to look at India today, where we are, we can't be insulated from whatever is happening across the world, geopolitical situation, tightening of the monetary policy, etc., etc. So there will be some pressure on exports. Manufacture will be under pressure, given. Consumption, personal consumption, is something which needs to be pushed up. Despite these two, for the full year, we are going to be achieving 7%. Now someone can say, okay, it's 7%, but you had almost 13% Q1, 6.5% Q2, and 4.2% in Q3 as a GDP. But can someone look at a block period, which is from 1920 to 20 to 23? If you look at this block period, the GDP has grown only by 3.2%. Because very often we compare with the previous quarter or the previous year, but the previous year, which is the base year, may not be the relevant year. So looking at this, and India's situation was already getting a little, India's economic situation was getting into a tight spot just before COVID. I think the silver lining is that post-COVID, how they have come back is commendable. And now my closing comments are that I feel that going forward, before that, you're talking about 3.2%, you're talking about 7%. FY24 also, we're talking about a GDP of 7%. What is the G20 GDP growth percentages like? 0.5 to 2%. So very clearly, from an investment climate perspective, India is clearly going to be a favorable destination. Coupled with that, I will just talk about 3 or 4 points, which is very macro. The government's intervention on the rupee dollar has been phenomenal. It is not allowed, okay, it went up to 83. It is not allowing the rupee to breach 83. Inflation is now under control, relatively, or almost peaked, I would say. Third, input cost is going down. Number 4, if you look at even the perception of the exporters or the importers, they are not taking too much of forward cover. The forward cover ratios are going down, which means that there is a renewed belief in how the economy is going to perform. Long story short, I see the investment climate positive, favorable, because of the steps that are being taken, because of the fiscal policy, because of the monetary policy. And I think it's only a matter of time before the manufacturing segment comes back, and it's only a matter of time before the personal consumption starts creeping up.
Well, Rajiv, I may be a devil's advocate here. This was so true just in the end of December, beginning of Jan. But over the last 2-3 weeks, what we have seen is there has been some pressures. There has been the credit offtake, which has quite come under pressure. Why? Because yes, the increasing impact of the interest rise which is happening. The MSME segment is going under pressure. The manufacturing, which very truly said, is what we believe that it was just coming back and it would have bounced back, but last 2-3 weeks is showing, anyways, there are many here who would have the same view. what happens when we have chief investment officer sitting and trying to manage the life insurance portfolio, which is like, I think more importantly, what would be your take with all the recent trends which you are forcing?
See, there are two aspects to it. One is that, we are in the business of assuming risk. So certainly we have to be very much mindful that how we are able to mitigate the risk which we have taken in our books. So what we do generally is there are two sets of, one is a new fresh premium which comes, which gets priced in at the existing level. And one is that which is already there in the books. I mean, only continuing already. So whatever is continuing, and again within that, to which portfolio does it belong to? For example, if it is a non-participating portfolio where the returns are guaranteed, then we need to actually take the required, derivative exposures to cover ourselves, which is what we are doing. And as in the previous section I mentioned that possibly the rates are looking like to be at its peak. So at this point of time, again, for any life insurance company, ALM management is very critical. We cannot try to time the market at all. At any point of time, our main aim is to actually, do the ALM matching in a proper way. So certainly, based on my ALM requirements, irrespective of whichever way the interest rates are moving, my aim is to see that my pricing rate is covered. And I take the required steps to protect my pricing rate. And any life insurance company, for the matter, investments team and actuarial team work in very close coordination. Because we have to continuously, raise the alarm that which way the interest rates are moving and what is our view on that. So that if any repricing required to be done, that's what we are, is required to. That is essentially, so we are trying to do that way, that wherever, the product inflows are such that where we can take some short-term exposure, the short-term rates are possibly the best after 3-4 years what we are seeing now. We are doing that, and wherever it requires long-term, we are not waiting for rates to further go. We have not done at each point of time. Of course, what we have done, some tactical calls we did, that we saw that if I can take some strip exposures, which were much better. So that is what was giving us some better returns. That's what we have done actually in a nutshell.
Thank you so much, Ajit. Amit, how would you look at the geopolitical risks which are creeping in off and on? Nothing as of now, but we just saw how it created a complete different cycle of investment last March to today. So you also belong to a sector which is again looking into insuring or covering risk. How would you look at covering this kind of risk arising out of megatrends?
Hello. Yeah, to talk about geopolitical risks, I think the India story remains intact and robust. The kind of ability to deal with and resilience to deal with external shocks is immense. I define it in three large events recent that India has dealt with, and I think it dealt with phenomenally. And same goes with different sectors, especially the financial sectors. One is that COVID, obviously more than 200 crore vaccines in such a short span of time. Obviously, it took time to get that vaccines done and other things, but that was one. Second is Russia-Ukraine tension. You see how India is seen as a world leader in and its position in the geopolitical world. You see how it has been rising. And the third has been the interest rate across the world, a recession, looming recession, I would say, not the recession, and kind of talk about all the inflation and other things. All three factors, if you see how we have been very resilient, and obviously after 9/11 and other certain black swan events, the premiums have risen. Insurance, one insurance sector, if I talk about reinsurance, a lot of hardening in the reinsurance rates and other things we have seen. But I think if I talk about specifically to Indian markets, I would say these geopolitical risks, and when I talk about world order risk and other things, there will be only two countries, and the smaller countries will start picking sides. The two countries, that is US and China, and then all the smaller countries, European countries, they will start picking sides in the very near future to come. So I think to sum up, I will say India's story remains intact, and it's just a matter of time that we should.
Thanks, Amit. Just 2 minutes, we round up here. And I would like to begin with Rajiv and then go the round. Since we are speaking about economic indicators, let's leave here some impressions that what you believe against each indicator, what would be your forecast? You start from here, we will take one each. Yeah.
So before that, whenever I think of risk, I remember of two dialogues. एक तो जो डर गया सो मर गया, and the second thing is डर के आगे जीत है. If you don't want to take risk, don't invest. That's the first point. The second thing is that investments is not supposed to be done with a very short-term horizon. I can tell you one thing, going by the current geopolitical situation, be ready that Russia-Ukraine is one. There will be more skirmish wars and such things in the border. With the election coming, be ready. Hindenburg was just a start to this whole carnival. There will be many more. But the fact is that in this process, the market will start reacting more maturedly than it did. And I personally feel, therefore, the risk is always there. But how we perceive risk is very important. Our ability to perceive risk will improve as we go along. And we should be expecting, be mindful, you will have more of these as the election comes and we all understand why. It will happen. So their market will remain volatile, market will show those, but eventually I believe in a year and a half, the market will stabilize, market will mature, and will be indifferent to risks which are not really risks. As a country, India stands strong.
Yesterday, you just reminded me, I was going through the Morgan Stanley this year, just what they have made. There's beautiful trend which is being seen in 3 parameters which they have listed as global offshoring, energy, and digitalization, where India by 2027 and 2030 is going to grow multifold and reaching all the targeted numbers. Anyways, to begin with, what do you believe the interest rate would be? Dollar rupee to you, some yield curve with you. So what would be your,
I would expect that 10 years, to be peaking at around, say, 750 to 775 range bound is what I can say. And I mean, short-term rate is going to now slowly go down because generally it moves very fast as well. So the moment RBI hits the pause button, thereafter it will recalibrate.
I think perspective on interest and inflation, I'll take a rain check. But one thing that Rajiv has mentioned, I would like to add, it is too risky to not take risks. And that is very true for investment professionals. Yeah.
So on the yield curve, I would say that we are seeing a flattening of curve beyond 5 years and 7 years. They have been stabilized. And I don't see the spread between a 5-year and a 7-year or a 7-year and a 10-year increasing too much in the short term. And I think it will remain at the current levels for the next 2-3 quarters.
Your question was on the dollar. I expect it should not breach 83. The government is very mindful of it. The central bank is very mindful of it. I don't expect it to breach 83, at least in the near term. Because of the run-up to the election, there could be external situations. But if those external situations don't happen, I expect the rupee to strengthen to about 79.80 in the next couple of months.
Wonderful. So we close here on a positive note. Thanks.
Thank you so much, Parul and the panelists. Parul, if I could request you to felicitate our panelists, Mr. Rajiv Newar, Mr. Sachin Jain, Mr. Amit Agrawal, Mr. Ajit Banerjee. Sanjay, if I could please request you to felicitate our moderator, Ms. Parul. Again, welcoming our moderators, Mr. Sanjay Patni, Associate Director and National Head Institutional Sales, Mirae Asset Investment Managers. Members accompanying him is Mr. Amit Goenka, Vice President Treasury, Family Office Hindustan Composites Limited, Mr. Harsh Kumar, CIO, Incubate Capital Partners, Sargro Family Office, and Mr. Tejpal Jain, CFOs, Swashish Diamonds Limited. A warm welcome to all of you. Big round of applause for the panel, please.
Okay. Very good afternoon, everyone. It's always dangerous post-lunch. Okay, half of the people may be absent, not intentionally, maybe unintentionally. That's absolutely fine. The only person I know is fasting. She's the only one who can be awake for sure. I'm very confident about it. But yes, thank you so much. And we heard so much in the last panel. We talked about interest rates peaking out. But I can only tell you why we are talking about only interest rate. I'm saying we started look at taper tantrum to maybe demon, to GST, to banking reforms, to COVID, to whatever we are seeing now on the interest rate side. I'm sure in our life, volatility is here to stay perpetually. Whether you like it or not like, I'm sure as an investor, even if you don't like, one-way secular movement of the market also, because you don't make money then as well. So one thing I can assure you that you will always like when the markets are moving up and down, you get actually an opportunity to actually pump and make money. Let me introduce again myself because some of the people may have joined late. My name is Sanjay Patni. I head India for institutional business for Mirae Asset Management. Mirae is the 10th largest AMC in India, and we continue to make an effort of connecting with audience, finance and treasury people, and try and provide various products. I'm sure Sachin talked about in the last about the debt, equity, passives, etc., all the products. So I think there's a diversified bouquet of products which Mirae has been offering in India for last almost 15 years now. I can also tell you that with the topic being so relevant in today's market, and I'm sure along with the panelists, the other one who was sitting on the audience also must be finding very challenging when the market moved from value in 2020-21 to growth, or maybe the volatility after that. And that's the reason you find deploying capital in the markets is not easy. I go back prior to my lunch session, maybe connecting. Of course, I like cricket like you do, obviously. But I can only tell you one thing. Did anybody watch India-Australia match today? Or did somebody follow? I'm sure you were sitting here. Last 3 days. Do you ever wonder that the test cricket, which used to be a good 5-day match and used to enjoy watching them, we used to actually go to stadium, online, etc., 2.5 days and test match is over. Why do you happen so? The players have become, maybe they panic, maybe they have safety guards too many. They use that maybe recklessly because they are supposed to do that, but that habit continues to do that. But can you do the same thing in the markets when markets are volatile? That becomes the most difficult part if you connect with that in the market side. Can you become the Rahul Dravid? Can you become the wall in the market conditions where you are? So I think that's where I'm only trying to tell you that amidst the volatility, the family offices will always find challenging irrespective of the asset class, irrespective where you are. On that note, let me invite and thank all the panelists for joining to this panel today. I have on my leftmost, I have Tejpal Jain. Tejpal is the CFO and Head of Family Office of Swashish Diamonds in Bombay. We have Harsh Dhanuka, the middle one from Delhi, handling SAR Family Office. Long timer there, more than a decade. And Amit Goenka, again a long timer in Hindustan Composites Family Office Head based in Bombay. Because I know all of them, they have been long timers in family office management. And I can only tell you that they must have seen at least in the same current role, at least 2 volatile market cycles for sure. There is no doubt about it. But what puts pressure in the markets is today's conditions. So let me put some questions to them, and we put them in spot on many things and try and understand where they see markets in these conditions of volatility. So maybe let me just jump to be Harsh, maybe to kickstart a conversation on this topic, which is volatility, but there are opportunities somewhere in between. So for you, what's been your core strategy that you've been managing in the family office? Something which remains fundamental. I always use the word all-weather fundamentals. What do you see there?
Hi, good afternoon, everyone. Thanks, Transformers, for giving us this opportunity. So, Sanjay, in terms of while you're managing family office wealth, the important piece is to know the objective and the goal, right? So, for us as a family office, the core objective remains first is the preservation of capital, right? And the next important objective is while preserving the capital, you need to create some alpha, and the wealth is to go to the next gen. So with these, objectives kept in mind, the core piece is that, we spend so much time, right, while we kind of write down our investment policy document, do our asset allocation, keeping all kind of risk, growth, goals in parameter. So what we have experienced over last 1 decade is during volatile times is the real test. How do you retain your asset allocation? Right? Because in such times, people, what we have seen is derail from their core strategic asset allocation and therefore, lose the track of the longer term objective for which they were supposed to have gathered together and to get that outcome. Right. So basically, although, volatility gives you opportunity, you take that opportunity for some kind of alpha generation, but sticking to the core asset allocation, and especially during these times, is the hard litmus test for family offices. Right?
Oh, sure, can't agree more. By seeing the market conditions over a period of time and seeing the cycles, obviously does that. Maybe Tejpal, if I were to move it to you, I mean, I've always been discussing with you, you've been an active player in the market as an investor. What are the products do you use to strategize? We heard the other panelists this morning about many things, but what other products do you use?
I think we are in the market since more than a decade as a family office, and we invest in across the vertical basically. So if you talk about the equity or fixed income or the private equity, we are always open to participate in any of the things. So only thing we look at is the risk reward. If something is favorable to us, we definitely jump in. So I mean, if you talk about the equity, then we have the various kind of the ETF product actually. So we look at these kind of the ETF product. Then if we come to the fixed income space, then I think the fixed income space is evolved from the last 5 to 7 years. We have seen evolvement in the fixed income space also. So unlike earlier, we used to have the just active fund. Nowadays, we have the passive fund also. In the passive also, we have different maturity product. Fortunately, we also have the duration product also. So if somebody want to participate actively in the fixed income space also, so they have the choice to participate in the longer duration also. So like somebody feel comfortable, okay, fine. I think if we look at the India story and so on, so basically there is, then I think around 7.5 and kind of the GSEC level will pause at what I think risk reward is favorable at that particular level actually. So if somebody want to participate in the long duration product also, then we have the availability of product, which I think if I talk about 5 to 7 years back, we have a very limited product. So I think passive fund, since we are the family office and we have to look at the various vertical of the product. So hence we prefer the more passive way rather than active way. In the passive, the ETF is the best product for us, basically similar to the index fund, so that we get the opportunity to take certain 10% portion which we are parking for the PE and PVC fund. So there we can put more effort so that we can generate the alpha. So this is the way we are exploring the product. So I mean AIF, various AIF product, VCP, and similarly all the passive product in the fixed income space and the ETF, various ETF products. So these are the available. And when we feel comfortable in the market level also, then we participate in the small cap funds and so on. So basically, so these are the product we are exploring.
Good to see somebody to be an active investor in across the caps for sure, because I've rarely found that since morning when I'm interacting across the caps for sure. So thank you so much for that insight also. So Amit, to move it to you, I'm sure like Tejpal mentioned, but you have a different strategy. We use alternate products, non-vanilla products, maybe some passive funds, etc. Any strategies which you feel are good for a family office and you have been using it?
In fact, we are also there in across all the products. So alternative investments, we do a lot of alternative investments nowadays. So we are across alternative products like private equities, credit funds. We are into kind of REITs. We are into kind of other infra products, which is into AIF platform nowadays. So private equities, we are very active. So they are generating a good alpha over the listed equities right now. So investing in a good private equity fund with a good track record of fund managers, will
Mhm.
give you a very good return over a period of time. But at this kind of investment, you need a little patience of investing 5 to 10 years at least. In credit funds, actually we are investing into credit funds into AI platform only, not on mutual fund platform, because they need a lot of patience there, a lot of kind of time of investing there. So AI funds in which we are tracking a very good kind of quality of companies in which the AI fund invest. So there we are not tracking a lot of yields like 15-16% kind of yield in the credit funds. We are sticking towards 11-12% kind of return in the credit funds, and we are getting a very good kind of return and very good kind of investment there. And in REITs actually, REITs are regulated a lot. So we have invested in REITs initially, but we are slowing down because a lot of regulation nowadays, the interest rates are very high. So we are just comparing the kind of interest rate with the REITs return. So we are finding that kind of GSEC investing is better, kind of bond investing is better than the REITs. So that is kind of, we are taking a juggling between the investment options, and we are finding nowadays the interest rate and bonds options are very good in this space. And passive investment, in fact, AIF, so we are into equity investing as well, and most of the investing we are doing through ETFs. And we have seen ETF investing has given a very good return over a period of 1 year or 1.5 years.
Sure.
And active managers has not given so much of a return, which passive investors has given, like ETF returns has given nowadays. So that kind of investing we are doing into AIF and passive investing space right now.
Sure. So, Harsh, just to have a conversation, we always say cash is king. Okay. Always feel, and volatility can't be the space where you are always worried about. Have you seen misalignment between cash and the business need somewhere? Or it's a pure family office, so there are arbitrage opportunities where I can take, and a long end I can take, and still I'm happy to make money there. Anything which you feel?
So I completely agree, cash is king. So, so for us as a group, we are both into active building businesses as well as, running the family office. So, and this was the situation which each business groups went into during COVID times, right? So as somebody was talking in the last panel that was a good time to go for shopping within listed market.
Yeah.
And so was a good time to support your own businesses, right?
Correct.
So, and for businesses groups, it was equally a challenge to balance to say that where do I invest, right?
Yeah.
But the point is that, given that where it's a complete investment office, you can obviously go towards financial markets and take those opportunities. But while you are running a business group parallelly, what happens is, to save that large ship is more important than, taking those smaller opportunities in the financial market. But nevertheless, saying that, with respect to during this volatile times, maintaining the cash in the books and maintaining, not letting it dilute is also a very important, action. So sometimes, as you say in markets, right, taking no action is also a very good action, right?
Yeah.
And, to stick to your philosophy and sticking to that cash and using it only in areas where you are 200% sure of, making some, kind of opportunity conversion per se is when one should use it. So during these times, I think what we are doing is, the core allocation remains static versus the tactical allocation that we always have in portfolios, right? So we use strategies like arbitrage funds or absolute return strategies, at least, which are more market neutral, right?
Yeah.
So at least that doesn't let your cash go down. At least it helps you to give you the inflation kind of return, over the cash, which you can use as and when you get the opportunities during these times.
Sure. So I'm not surprised, because when you said this, a lot of investors, I know at least for sure in so long, being in institutional business in mutual fund, a lot of people use liquid fund for a 3-year investment as well. Okay. So I can tell you that with the indexation benefit, I have seen investors being so conservative as well, but they are happy because they don't want to go through the volatility. That's the question. So I'm not surprised there indeed. If I were to ask you as a conservative treasury and family office, okay. Earlier panelists said risk hai to ishq hai. Okay. But I'm only asking a question. You are conservative. How do you make money?
So actually, we are conservative investor, and we are moving toward moderate investor right now. As a conservative investor, actually, most of the funds are into fixed income side. Like more than 50% of the asset is into fixed income space, and we are managing this through fixed income kind of papers like G-SECs, SDLs, and kind of PSU bond funds, PSU bonds. So conservative approach we are following, and we have towards credit funds also, and very selective credit funds, not managing a lot of funds into credit funds. So we are managing as a conservative approach in equities as well. So we are not going solely onto equity investing through active investment. So we are playing it through passive investments. So on ETFs we are investing, through ETFs we are investing, and a lot of investing is through ETFs only in equity.
Sure. I know Tejpal is not liking it though, being an aggressive and equity investor for sure. Tejpal, let me ask you, on that note, let me ask you an entire your liking. Does fixed income excite you equally? Though you are equity long, you know that asset class will make more money.
Ultimate objective for any of the family office is to generate the post-tax alpha, basically. Correct. Return,
Sure.
actually. Correct. So if I am able to make 10% kind of the return, even in the fixed income space, it doesn't matter whether the equity or the fixed income. So fixed income also excites me as equal to equity also. Rational, I'm saying like what happened if I will go for the long duration fund. So if you look at the current year's GSEC level, which is currently hovering around 7.5% kind of, correct?
Sure.
So if I start to taking, I know, timing the level, any of the level is very tough for any of the investor basically, or for any of the family offices, correct? But when I know I have the visibility, yes, this particular portion of the fund I can park for the longer duration, and doesn't matter, even though the uncertainty or any kind of the volatility will come, I have the appetite to pass through all this kind of the volatility. Then I don't mind to parking the money from the long duration fund also. So that's why even in the current scenario, we invest even for more than 10-year paper, we are parking. So that ultimately we have to generate the alpha, better return basically. And if I am able to generate 10% kind of the return, it makes sense actually to park money into the fixed income space also. And fortunately, even the current scenario, we have a lot of the fixed income product, which is where the duration is more than 15 years, 20 years, 25 years. So it makes sense actually to park money when we know India is a growing economy and the interest rate is going to come down. We don't know the timing basically, but yeah, when something is like inflation is when sometime inflation will peak out actually, so that the cycle will reverse. So we don't know whether at that particular time I can time the particular level and park the money into the debt. So I think it makes sense to park money into the fixed income space also, particularly if somebody want to make a better return, then long duration fund makes sense.
Sure. So we talked about domestic, Harsh, maybe role of global allocation, global funds allocation, or global market participation. How does that work in your markets? Maybe along with currency, if you want to share that.
So see, as we were talking about, deglobalization and the new business trends as a trend of investment. So for us, it came at more. We were lucky that one of our promoter family had turned NRI in 2015, right? And that had led to start of the global part in the portfolio. So, and therefore from then is when we were kind of setting up the complete family office structure out of Singapore, right? And what we've kind of experienced over last couple of years, right, during this volatile times, during COVID and all of that. So the clear objective for us of starting global was not just for the sake of currency diversification, but it was more from the sake of getting a real diversification from geography perspective, currency, and then more and so the business diversification perspective. So the key businesses what were available to invest globally are not available to invest in India. Right?
Okay.
So the idea was that at least that gives you a real way of diversifying the portfolio across categories, across segments, across currencies to that extent. So during this volatile times, what happened was, for example, you saw China at one point of time was going nowhere, and suddenly last 1 year the same China gave you 30-35% return, right? So at least, as we saw over last couple of years, right, each asset class has its own cycle. Similarly, each economy has its own cycle and behavior.
Including US for sure.
Right, including US for sure. So maybe the same market for US, which was not investable 2 years back, is giving you an investment opportunity today.
Yeah.
Right. So going forward, and with next gen kind of coming into the families who are more, kind of locating outside India, I think global would be the trend that most of the family offices would start getting into.
Sure. So, Tejpal, if I were to ask you, because the bigger challenge for any family office or any CFO will be, how do you benchmark your own returns? What benchmarks do you use while managing portfolio investments?
I think the benchmark for me is always the nominal GDP growth minus 3 or 4%. This is my benchmark. So if I am able to, to be precise, if I am able to make 11 to 12% post-tax return, it makes sense for me. So that is the benchmark we are setting.
Sure. So, Amit, if I were to ask you, maybe you can take that mic. You touched a very important point, if you ask me, okay, not related to maybe volatility, but you said market tests patience. Now, I'm sure there's a deep meaning to it for sure. Do you want to elaborate that?
Yeah, actually this is a very true phrase, ki market test patience. In fact, we have seen a lot of cycles in the past. So very recent is COVID one. So in COVID, we have seen a lot of asset class falling down like anything. So we have just been patient in our family office, and we have not taken any emotional decision or any absurd decision. We have not sold any asset, and we have stick to our principle of investing. In fact, in which we have invested, we have belief and faith into core principle which we used to have investment decisions making.
Yeah.
So we have taken our patience, we have kept our patience in the investments which we have done, and we have not taken any absurd decision. And hence we have not lost anything in that situation. In fact, we have made a lot of investment in that situation and taken a lot of very good, very attractive assets at very cheap valuations. So patience pays you a lot. At the same time, volatility gives you a lot of good opportunity to buy also. So in fact, we have to be patient with our investment decision and long-term goals. So
sure.
That is my view. And
so on that note, let me catch hold. Let me put you on spot. Which is the sector or any investment, one thing which you feel that I was too patient and I lost money?
We shouldn't lose money, first of all.
Or you lost an opportunity, I should have been there. Okay, let me put it this way.
We shouldn't lose any opportunity as well. In fact, we
which is an ideal state.
We have to grab the opportunity if it is there.
What was that opportunity which you feel is, there is no fund manager, I'm sure, or a portfolio manager can be say I was the most ideal one?
No, it is not there. It is based on the situation, in fact.
Harsh, let me ask you the same question to you. And be honest, huh?
No, I'm being honest to the extent possible, right? So for us, the patience was well tested. So for us, this liquidity event for the promoters had happened in 2012-13, right? And at that point of time, real estate was at its peak, right? And when you get liquidity event, real estate becomes the first port of call,
Sure.
at that point of time to
Sure.
invest into. So, and it had tested our patience till 2020, I would say, right?
Correct.
And it was always a drag on the portfolio, but we
Correct.
still held on because there was an allocation which was made to real estate and we had to keep it. And come 2022, it, made up all of its return.
Turnaround, yeah.
Right? So that is where, we therefore, it tested our patience and it gave us more convincing answer that asset allocation is the key and you need to stick to it if you have
Sure.
allocated something to that extent.
Tejpal, same question to you. Which one?
I think so far... Since
Harsh was honest, huh? Just for
I am
information.
also-
Amit was not. Okay.
I remain the honest only. So I think so far since we largely play in the asset allocation way actually, so probably I think mostly we are in line only. But if you ask me honestly, then I think that we park some certain portion into the credit fund in 2017-18. So that was the point. I think if we will be invested rather than the credit fund, if we save the money, if we invest in equity, any of the equity fund, then I think we can make better return. And we just away from the kind of the stress we went through in the from 2018 to 2020 actually. So there was I think this is one of the I think investment where I will say not lost actually, but yeah, not a correct decision.
I can only tell you that people, if you ask them what is the best fund which you managed on the opportunity with, everybody will have 20 answers, I can tell you. The moment you ask them which one did you lose, you'll take a back seat and you'll say, no, 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 I didn't lose anything. That's what Amit did. Okay, so that's why I wanted to put them on spot. I can only tell you by correlating with your markets again, you need to be Mahendra Singh Dhoni in those markets. Okay, you have to have calm, you need to have patience. In any conditions, you need to be patient. When we took over as captaincy, he asked the 3 top batsmen out of the team. Didn't bother. He fought. He took his stand. But same thing, when the pitch is patchy, you won the 2 first matches, India-Australia, but you lost the 3rd one also. You can't deny that. So volatility or cricket, doesn't matter. As long as you have calm, you're patient, you're running the right strategy, doesn't matter, you can still win the game. So thank you so much for all of you, and thank you panelists for fantastic and almost honest views. Thank you so much for being there. Thank you so much everyone for listening to this.
Thank you so much, Sanjay, again for that fantastic session. Big round of applause for the panelists as well. Sanjay, if I could request you to felicitate our panelists, starting with Mr. Amit Goenka. Mr. Harsh. Mr. Tejpal. Thank you. With this, we now move on to our next fireside chat that's on evolving world of investing, ETFs, alternate and hybrid investments. Please join me in welcoming our moderator, Mr. Siddharth Srivastava, Head ETF Products, Mirae Asset Investment Managers Private Limited. Members accompanying him is Mr. Dinesh Shah, Chief Investment Officer, EMSA Venture Capital, Mr. Ajit Bhaskaran, Director and CIO Fixed Income, Karvi Capital Limited, and Shubhranshu Panni, Fund Manager, Treta Advisors. A very warm welcome to all of you. A big round of applause for the panelists, please.
Good afternoon, everyone. Last panel was pretty interesting. It did a lot of my job because they talked about ETFs, passive investing, and importance of portfolio allocation, right? And that is what I typically speak when I'm part of the panel. My name is Siddharth Srivastava. I head ETF products for Mirae Asset. And like in the previous panel, we have obviously domestic products, both on the equity side and debt side. And like panel mentioned, how important is global allocation also. So in that pursuit, we also have very interesting products on the global opportunities. I have the honor of moderating a very diverse panel. I must say one person is expert on the VC side, one person is expert on the fixed income side, and the last person is expert on the real estate side. I think 30 minutes is going to be pretty short to understand each and everything about these 3 interesting domains. So starting with you, Jinesh, how has the recent turmoil impacted the VC domain from fundraising and investment point of view? One word which we are hearing a lot is funding winter. Are we seeing funding winter?
Thanks, first of all, Siddharth and Mirae Assets for having me here today and at the Family Office Convention. I think we're all talking about the funding winter, and usually there's no smoke without fire, right? They say that. So the funding winter is not, but I think there's many different meanings associated with it. I think the most primary one is you're not going to be able to raise funding, or it's going to be tremendously hard to raise funding. Is it a bit harder right now to raise funding? Yes. Our venture capitalists just sitting with hands folded? No. We have very clear mandates from our funds and our partners to invest the money in good companies. And just because the global macroeconomic situation is a bit affected right now, that doesn't mean good companies aren't emerging. Good founders aren't looking for capital, be it early stage, be it growth stage. The one thing that I have noticed, and it's something that we I think notice from time to time in the markets, is correction in valuations. And I think when you see sort of the long-term sinusoidal effect of macroeconomic factors, which also affects the VC world, it's not the worst thing to happen.
if you still have a, a sound business, you have a good team, and depending on what stage you are at, if you're hitting your KPIs decently well, VCs are still very realistic about funding companies. And then there is, I think there's nuanced ways to look at this one umbrella term called funding winter. I think there's geographic differences in terms of which regions perhaps have experienced more of a slowdown. India per se hasn't luckily seen as much of a slowdown as many of the other markets globally that we see. So we continue to see a lot of growth here. And when I speak specifically about, when I get into specific domains, the key focus for us at Ahimsa VC, where I serve as a chief investment officer, is to focus on the alternative protein and alternative material domains. These are very much sunrise sectors in India at the moment. So there isn't any slowdown in terms of funding on that front. If anything, there is growth in the number of companies emerging in the space. And when we choose to make a decision to fund a company or not, we never sit down and discuss, oh, it's the funding winter, let's not fund the company. I know it sounds funny, but I mean, a lot of people, I don't know what connotations exist out there. We never talk about, funding is drying up for us as a fund. It's more about looking at the new exciting companies emerging in the space. For us, business kind of remains as usual. But yeah, I think on the correction side and on the valuation side, there's certainly corrections happening. And I think that's overall, I think we have a very diverse set of people from different financial backgrounds and family offices and businesses. And I'm sure from time to time we've all experienced, oh, look at the valuation of this XYZ startup blown up out of where the revenue doesn't support it, their ROAS or whatever, the key KPIs don't really support it. And so times like these kind of help bring valuations back in a bit of check. But that's all I'd like to add, I think.
Sure, thank you for that. I think probably I'll obviously pique your mind about protein-based alternatives, which you talked about. Yeah. So Subhranshu, coming to you, you have a very rich experience on the real estate side. So can you give us a brief landscape on real estate investing? What are the various segments one can target right now? And what is the preferred investment medium?
Thank you. My name is Subhranshu, and I've spent about 22 years with JLL across a couple of different business lines. It's a very big topic, of course. We used to do a couple of days sessions on each of these. But I think from my personal perspective, after spending these 22 years, we are the best time for real estate in India. And I'll say this with a lot of semblance. Since I started 22 years back, the real estate space in India has moved from unorganized to organized to grade A. So if you see the offices, today we have about 698 million square feet of office in India. Every year we are adding 50 million square feet of grade A space. Grade A space is where international funds come in and put in FDI money. Last year, $2 billion came into India in FDI in office space. So that space is so attractive for even international investors. And obviously Indian investors also lap it up. Again, we have moved from every building being strata titled to people building large blocks, owning large blocks, floors, buildings. And that ownership is now getting moved from corporates to funds to HNIs. And a lot of HNIs working in this space. You can get a good building for 200, 300 crores, and these are good assets, grade A. Clients are sticky. They all have contracts of 9 years, so it's really bankable. And you know that it's all these days LEED certified, sustainable, all the check marks for corporate. They'll come in and check these things. We have got occupiers these days, banking, financial securities, IT, ITES. The occupiers are grade A, so it's much, much more easier for people to invest and retain those assets from a long-term perspective. The second asset class, which is really now in thing, is warehousing. It's a very recent phenomenon, but it's catching up fast. We currently have about 350 million square feet of warehouse space in India, all metros and tier 2 combined. We are adding about 160 million in the next 2 years. And there are already 10 large funds from global markets who are investing in this. Again, $1 billion got added last year. This is again very vibrant. We have Gati Shakti coming up. We have PLI scheme of government. So for the next 20 years, this is going to have a bull run. It's an asset again which needs a little bit larger bucket of money, 100 to 150 crores. Very rightly placed for family offices of size. Again, very sticky assets. Anybody who does a warehouse, if they want to do a mechanized warehouse or a robotic enabled warehouse, invest their own money in these technology. So they are much more sticky. So they'll want 10-year contracts, 15-year contracts. If you're Amazon, you'll want 20-year contracts. So from a family office point of view, this is a really secure investment for a very long-term contract. Gives you a very long sight of the returns to come. Then you have the usual residential. And today again, this has become very organized since from where we started. Our people are well-traveled. They want better quality spaces. So all the developers have started moving towards quality. We had a RERA, which is the Real Estate Regulatory Act, coming. This has really brought a lot of teeth to the consumer. So today, a developer has to register under RERA if he wants to sell. And if he sells, he is liable by law. That if he doesn't deliver, he can go in behind the bars. And you already see it every day. You read in papers that somebody has gone under RERA. They did 100,000 cases in the last 5 years against developers. So these days, landowners don't want to get into development. They are really wary. They say, we can't handle these hassles. We don't know what we'll face. So we'll better do joint ventures with these corporates. So there's a lot of organization happening up in this. And about 55% of today's India's developers are organized developers. Many of them are listed. So that residential spaces gives you opportunities in listed spaces, listed companies. You could also invest through some form of AIFs or private equity funds, one of which I am thinking of starting now, which is in the filing process. So I think real estate is giving good basket of different asset classes which have different cycles, which have different advantages to invest in. One more, which is a very recent but new thing, and if you have a family office of a larger size, which may be of interest to you, is data warehousing and data centers. This is again going to be a very sticky thing. All of you must be seeing about data localization, that every data should stay in India. When we started this at JLL, this business about 7-8 years back, this data localization was not a thought. So there were only people who came in, wanted to give edge cloud computing and edge technology support in India. So there were very few players. But today again, this is a 50 million square feet space, adding international funds coming in. So I think we have about 6-7 choices for people based on what type of risk you want to take, whether you want to go active, whether you want to go passive, whether you just want to, if you're used to stock market, whether you want to just follow the stock market route. The office spaces also have now got into REITs. So you get all bouquet of types of choices in the real estate space. It may not be plain vanilla stocks or bonds, but there are really a large bouquet of them.
So that's pretty interesting. I think the way real estate is evolving, it's pretty interesting to know. And I think my next question is going to be about warehousing also, because that is one thing which is rising up pretty quickly. But before that, Ajit, one question for you is, in current times, I think this question must have been asked in last 1.5 years since Fed started raising interest rate pretty frequently. But still, in current times, which are the interesting segments you see in debt market? Where do you think opportunities lie from a short and a medium term point of view? If someone wants to just park money for a year or 3 years, where do you feel the right segments are?
Hi, this question has been answered by most of the panelists before us. I mean, it's been time that it is the debt markets time, as they call it now. You get these times once in 5 years only. So you've seen debt market going around the rigmarole, going down every time. This is one of those times when we see debt markets have come into the vogue and everybody is looking at this point. So as of now, if you look at debt market, the the sweet spot I would see is into the medium term and to the longer term segment. Maybe this is the time when you should be starting to build your duration. I'm not saying you should be investing the 100% of your allocation into debt here, but 20-30% of the debt allocation should start moving into the debt market. Why I say that is because we still not reach, we are somewhere near the end of the rate hike cycle. So we may have another 25 to 50 basis points of rate hike going forward from here. If you want to catch that and still be part of the game, then you have to start investing from now on. And as some panel had said before this, we may see the rate hikes coming pretty soon in the next one and a half, next policy meeting most probably. But it will be stagnant for some time, and then the rate cut cycle will start. Now, why I want you to get into these medium-term segment is because, with the type of volatility which you see on the equity markets, I don't think you're going to make much. I mean, with all due respect to the equity markets, you're not going to see much of a return coming in the next one and a half years. So it is a better time for you to get into the debt market here and cover your risk and, earn something out of it.
Sure. Thanks for that. My next question is for Jinesh, and Jinesh talked about protein-based alternatives and pretty interesting portfolio of companies you guys have invested in. So my question is, obviously, what sort of interest are you seeing from investors for investing in such niche segments? Because there's obviously a question mark on what sort of demand these products will eventually have. Is it sustainable or is it not sustainable? So how do you address those queries also, and what sort of interest are you seeing from investors?
So I think that's a great question. Let me take a quick step back here and make sure that the audience here is aware why I'm on this panel, and because it's an alternative investment panel. Ahimsa VC as a fund, the fund that I run with a few partners, is India's only fund focused on investing in the domains of alternative protein and alternative materials. And there is also an element of the fact that this is a whole alternative category in terms of climate tech and impact tech that family offices and all kinds of investors alike can consider. What is alternative protein? What is alternative material? It's basically the next generation of, say, protein alternatives, for example, that are alternatives to animal products. And why is the world looking at this at the moment? Obviously, there is one completely different element of the animal ethics that's at play, which is partly where our name of Ahimsa VC derives from. But in addition to that, there is a key need for all countries around the world to secure the future of their food and consumption. No matter what happens around the world, people will still eat food. And what we're seeing right now very factually in terms of data is that the consumption of animal-based products, primarily meat and seafood, dairy, a lot of these areas is going up globally right now. Especially India and China are the largest contributors to the current and for the foreseeable about a decade at least of growth in demand for animal-based proteins. And now, why are we investing in startups trying to create alternatives, be plant-based, cell-based, fermentation-based, alternatives to, to chicken or beef or dairy? Why are we even doing any of that? One, because it's 90% or less water, land, and greenhouse gas emissions consumed in producing a product which a few companies globally, not all of them, have been able to get it to taste parity and now are inching towards price parity to animal meat. And from a public health perspective as well, there are a lot of concerns with consuming meat, carcinogens, mercury in seafood, cholesterol that comes in with the dairy, many questions. And globally, because of diabetes pandemics, because of heart deaths related to heart issues and cancer, and many other such reasons, we see there is a large number of people that are called flexitarians, which are now switching to eating more and more plant-based or animal-free products in their diets. And alternative materials, just as a quick nutshell on the side, is creating materials like wool, silk, leather, any of these using alternatives to animals. Again, also because The animal agriculture industry single-handedly is the largest single contributor to greenhouse gas emissions in the world, uses about 81% of all of our farming land in the world and gives us only 18% of the calories. So when you look at hundreds of millions of people going hungry around the world and our population inching towards 10 billion people over the next couple of decades, how do you feed 10 billion people sustainably by 2050? That's the big question a lot of countries are asking, especially the likes of Singapore, the Middle East, and many, many other countries around the world. Now, India has, agricultural background and strength, naturally, lends itself to being a strong player in this emerging industry. And this industry, I've been involved in this space since about 2013. I've worked across 3 continents, personally lived there, and worked with startups across 6 continents now over the last decade and a half at least. And there were probably less than 5 to 10 startups back in 2012, 2013 when I started getting involved in this space. And I just switched careers from Wall Street to Silicon Valley at the time. And at this point, it's hard to keep track of how many companies emerge in this space globally. India as well, this domain was kind of born in India in about 2017-18. And we now have close to about 150 startups at various stages in this domain in India. So that was just a little bit of background setting as to why we're talking about Ahimsa VC or alternative proteins here at all. And from a family office perspective, given that's sort of our focus today, I work with a couple of family offices already that are allocating a part of their capital to this domain. And that's not just impact driven. This is one area where a lot of the large food companies as well, or the large conglomerates in India, be it the Tatas or the ITCs, or globally, the Mondelez's or Tyson's, folks, Nestle or Danone, folks that are big in chocolates, folks that are big in dairy, folks that are big in meat, in chicken. The largest companies in the world are also investing in this domain, are acquiring companies in this domain, because they clearly see this as the future of food. And for this reason, a lot of family offices are also looking at, diversification naturally. That's a common, thing to do in order to have a healthy portfolio. And this domain is a sunrise sector in India. And India really has the opportunity to be a manufacturing hub, a global hub, not just for India's own domestic demand for mock meats or plant-based meats, or in the future there's other segments where we actually take a real cell, like a living cell from an animal, and actually grow animal meat, but without growing the whole animal, without any slaughter. And it's identical to animal meat, except it doesn't have the antibiotics, the hormones, all the negative impact, and of course the land, water use, and the greenhouse gas emissions. So when you take all of this, I mean, sometimes when I just listen to myself speaking, it may sound like we're talking too much about the greenwashing, the environment, and the greenhouse gas emissions. But this is a real problem that countries like Singapore, for example, they have a mandate. They want to have 30% of all their food production domestically by 2030. They have very little land to be able to do that and resources. The Middle East and the GCC, a lot of them are doing tie-ups with companies in our domain, large multi-$100 million contracts of setting up manufacturing and such. Why? Because 95% of the food, not just in Singapore, but also in the GCC countries, is imported. And this presents a huge risk from a food security point of view, from them securing their future when it comes to other political sort of aspects, perhaps even war in the future, right? So these countries very clearly recognize where the problem is. The alternative protein industry is here to solve the fact that we all love dairy, meat, and poultry and seafood. It's just that it needs to be made in a much better way, so that we're not throwing so many resources at this one engine to create animal products, which is highly inefficient and just not scalable anymore, and can't meet the growing demand. And that's the reason why, I think a lot of family offices, I personally have worked with several just within India and many outside, that are starting to allocate fairly non-trivial chunks of their, wealth investing into this domain.
Sure, that was pretty interesting. I'll come back to impact investing, which you mentioned. But before that, Subhranshu, like you mentioned, there is a lot of interest in the warehousing segment right now. What are your views, and how do you see it evolving in both tier 1 and tier 2 places?
So I think 2-3 things which is driving this whole change in the warehousing sector is one, India is becoming the center for a lot of production linked incentives, etc., and manufacturing coming back into India. The road network is improving, logistics network is improving. The GST brought in a big change. What the GST did was it decentralized inventory management. So today when I look at it, the key drivers in this sector are all the 3PL players, and they have got their philosophy of in-city deliveries, delivery within 24 hours, central warehousing, etc. Then we have renewables and EVs, which are big in this sector. And we have got a host of funds which are following, because India is still has the least amount of per capita warehousing in the world. We need more. So that's why we are seeing that it's going to grow for the next 20 years. India is still the cheapest market in the world. Our warehousing rentals are 28 rupees, 29 rupees for the same level of infrastructure, which is like $1 in a Singapore, Hong Kong, anywhere else it's $1 plus. So we are, and we still have a lot more things to carry with a lot of population, a lot of support for this logistics industry, which means that the play for somebody who enters in now, the prices are only going to rise one way up. The stickiness is going to continue to be there. And we are just adding grade A spaces. So last year, 68% of the leasing market was grade A. I think this will just keep increasing, and this grade B will get squeezed out, because nobody wants to go to an inferior place which which is not conducive to technological advancements, modern technology, robotics, etc. I see a lot of heat and investment in this place. We really have all the global players looking at India now. And they unfortunately can't become aggregators. They can't come in. It's a very slow process to build ground up. So they are at some point of time going to start pulling together small players or people who have invested, give them a better return, and consolidate that space. So I think that's a big space for HNIs to get in and be those first ones to build and make the cream and the profits out of, in short term as well.
So since we are running short on time, my next question is again to you, so that you can summarize what you just said. So in terms of, you talked about warehousing, you talked about residential as well as office, but what about opportunities in tier 2 market, and what are the challenges? Should we focus right now on tier 1 itself? There are good amount of offices opportunities also in tier 2. What are your views on tier 2 versus tier 1?
So that's a very good question, and the answer could have changed if it would be pre-COVID or post-COVID. As of post-COVID, I think the tier 2 market is really getting strong. In the office segment, what has happened is a segment of the population who comes to office has become work for home. So in various offices, they have different philosophies of working from home. Some come in only for monthly reviews. Some come in for, some sets of work are completely back of home. And today, what we are seeing is a lot of corporates, ITS are really setting up some form of, WeWork type of solution, which is consolidated spaces in all tier 2, tier 3 cities. So there is a significant boom of these kind of offices, which should not be there till 2019. In 2019, you could get any office space in any other tier 2, tier 3, it would be vacant for a long while. But today, suddenly everybody is there. So that's from the perspective of office. Now, from the perspective of warehousing, this delivering in 24 hours, delivering in 4 hours is going to change the dynamics of it. Already we see that the metros already have got some critical mass, and people are now going to do those intermittent type of stops. It's a logistics and a networking map they have to create. So it'll differ from sector to sector. But what will make it really local, that is go back to tier 2, tier 3, is these industries of manufacturing and renewable energy. These two will make it very local in tier 2.
Got it. Thank you for that, Subhranshu. Ajit, we were discussing before the panel, you were talking about high yield segment. So what are your views on high yield segments? And you have obviously handled products on both mutual fund side and PMSAF side. And where do you feel in terms of the right segment is for which sort of debt product currently?
Actually, the high yield segment doesn't mean that you're always looking at high yield or junk bonds or something like that. Most of these high yield bonds are, or the companies which are giving you high yield returns are not because they are in the lower category or lower rated, just because they are in that segment. Like for example, if I can give you MFI example, MFI is an industry which is at the lowest end of the pyramid. So that's why the risk associated with those companies are much higher. But over a period of time, with the regulatory changes, the MFI sector has come over the curve, and the risk associated is reduced much. It has come down quite a lot. See, given a chance, if you're looking at a high yield product like a PMS or a mutual fund portfolio, and that is the credit part of the portfolio, it is always better to be on the high yield AIF or PMS side, because they've got much more visibility or much more opportunity to go into those type of investments there. Second part, the second question which you asked me is, is it better to be in the mutual fund space or is it in the PMS or? It's not or, it is and. Means you got to be on the mutual fund side as well as on the PMS side. So your allocation into debt can be divided into mutual fund and then into high yielding space, because high yielding space will always give you that alpha which mutual funds will not be able to give you.
Thank you for that, Jeet. And finally to you, Jinesh, and very quickly, you talked about impact investing and the niche segment of venture investing which you're talking about also talks about impact investing, right? Thinking about climate changes, greenhouse emission. There's a concern about greenwashing also. So, is India evolving from just return-based expectations to impact investing also? What are the investors' expectation when it comes to investing in such sort of domain? Because nobody is going to give up return expectations completely, while he or she may be wanting to do a positive impact. So how do you deal with that expectation, and what sort of return expectations these clients have?
So quickly addressing this, we're talking about for-profit investments, and just from that basic connotation, no one should be looking at only impact returns, is how I look at it. Right? From a for-profit investment perspective, there always needs to be returns. In this case, though, we're very clear that we need to marry the impact return and the capital sort of the profitability at play. India is still a very, very early sector when it comes to, I think, climate tech investments overall. We see a lot of talk about when it comes to sustainability investments in the solar world, in the EV world, batteries, automotives and such. But the one key factor that I think folks are now starting to understand in the investment arena as well, Stodi, because there's a lot of credible sources putting information out around the world, including the UN, be it some of the top universities you're talking about in the world, that animal agriculture continues to be and has been for a long time the largest cause of deforestation, the largest cause of freshwater use, and giving us very little calories in return, a lot of land use at play. We're talking about the largest cause behind most of the biodiversity loss we have done in the last 50 years alone. We have wiped out 70% of all flora and fauna species around the world when we talk about impact. Now, what if you can invest in something that is at the very core of why these things are happening? Alleviate that, feed people in a better way, and make some massive returns on the other side of it. This is really the proposition that we are sitting at the intersection of. Does everybody understand it at the moment? No. But there is a lot of investors that are focused on impact investment now towards climate tech, understanding this is a big domain. And that's also because a ton of investment globally is happening in this space. Just last year, one singular company in our industry raised a $400 million round. And this is not a singular data point that's very isolated. We're seeing in the last 4 years alone, year-on-year growth of at least 20, 25, 30% in the overall capital allocated in this domain, even though kind of COVID hit us in the middle. Secondary markets are starting to get active in this space. Globally, India is starting to become a very exciting space. Within India, we actually do have all of our GPs at the moment. 4 out of the 5 of them are based in India. One of them is from the US. And we see a lot more global interest. Hopefully, we'll get a lot more local interest in the space. And with Ahimsa VC, we definitely very clearly want investors. This is not a 3-year e-commerce investment return or a fintech return in a 4-year, 5-year cycle. We're looking more at a 7+ 7 to 10 year sort of return cycle. So definitely needs to be patient capital. There's positive and negative connotations to patient capital. But in this case, there's a lot of deep biotech. There's a lot of deep tech work that happens in this domain as well. So while there needs to be more patience, people are already seeing benefits and returns on this globally. So I only see this as a continued growth story in India. Those are all the markers we're seeing at the moment.
Thank you, gentlemen. I think we overshoot time way too much, but hardly help because we have such a diverse panel with us. Those are very insightful views on a wide range of opportunities in the investment world. So thank you once again, and thank you, audience, for patient listening. With this, I'll wrap up this panel discussion. Thank you.
Thank you so much, Siddharth, and the panelists. Siddharth, if we could request you to felicitate our panelists, starting with Mr. Ajit Bhaskaran. Mr. Shubhranshu. Mr. Dinesh. Nidhi, if I could request you to felicitate our moderator. Great, thank you. So yes, we come to the end of the panel sessions. Now we'll start with the breakout sessions. We take a short break. We start the next session at 4:10. I request all of you to please carry your belongings, your brochures, your laptop bags, or just set it aside of the ballroom. We are going to change the setup for the roundtable session. I repeat, please carry your personal belongings, your notes, your brochures, your bags, or you can just set it aside to the ballroom, maybe left or right. We are going to change the setup for the ballroom, the roundtable session. We start off with the roundtable session. As you see on the LED screen, there are 5 topics being discussed, and you see the format changed. We've put numbers to the tables as showcased on the LED. This is table number 1, table number 2 on the left, table number 3 at the center, table number 4 at the right behind, and table number 5 at the right behind. The table numbers are already on the tables. The topics are highlighted as you see on the screen. Table 1, number 1 is on the startup investments in listed and unlisted space, which is on the right in front of me. Table number 2 is just on the left side. Yes, Mr. Pani is already there on topic growth and opportunity in real estate investment management. Table number 3 is right in the center, discussing on the family office private equity investment and trends. Table number 4 on the right-hand backside on succession planning strategies for family offices. And table number 5 on the left-hand side backside, that's on passive investment for family office. I give you a quick 3 minutes to make a choice and take your respective seat at the tables of your choice. Quick round of introduction. The speakers will be setting the context, giving you a highlight on the industry trends, you highlight on the challenge areas, and work out action points. It's as simple as that. So you can start off with the discussion, and we will close the discussion at sharp 5. Good evening, everyone, once again. We move on to the most awaited part of the conference. That's on the India Family Office Awards. To do the honors, may I invite Mr. Sanjay Patni, Associate Director, National Head, Institute State. the next title is for the best family office risk management. That goes to Srinivas Shishadri, Mirabelle's Investment Trust.